We are live. ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. Hearty welcome to Jnanarjane, Empowering Excellence. Friends, we have already completed 2 days of 6 days workshop on international taxation. Day 1, we learned the overview of international taxation and section 5 and 6. Yesterday, the whole day, we learned in detail section 9. Today, 2 other very important and interesting chapters of international taxation is enlightened by 2 eminent speakers, one from Bangalore, another one from Ahmedabad. Bangalore member is our own renowned advocate, CA KK Chythanya is with us. On behalf of Bangalore branch and on behalf of all the participants here and panelists here, hearty welcome to CA KK Chythanya sir. Hearty welcome. Friends, in the next technical session, CA Dhinal Shah from Ahmedabad is going to join, maybe in the end of this technical session. So we'll welcome him when he joined. Hearty welcome to each one of you. Your overwhelming response for this workshop is made us to organize this 6 days workshop. Your support for all our Bangalore branch program is the reason we are conducting more and more programs. That is the reason. So with that note, hearty welcome to each one of you, friends. I'll take a minute of your to inform our upcoming program is 21st June is International Yoga Day. Your branch is hosting International Yoga Day on the early morning of 21st, that is Monday early morning 7:30 to 9. We are celebrating International Yoga Day, and it is arranged by eminent yoga specialist, Dr. Naveen K. Vishweshwaraya. He is going to impart the knowledge on yoga, the benefits and other advantages of yoga to all of us. And later, another 45 minutes from 8:15 to 9 o'clock, it will be yoga practice. A practice session of 45 minutes also will be there. I request you and your family members, please register for this program and join in that yoga session from 7:30 to 9 on Monday, 21st June. With that note, once again, hearty welcome to each one of you. Over to Divya. Divya, please introduce our respected speaker.
Yes, sir. Thank you so much, sir. A very pleasant good evening to all the participants and to our dignitaries and the panelists. To give a brief introduction about today's first session speaker, we have CA Chythanya KK with us. He is by qualification BCom, FCA and LLB. He has secured 8th rank in Karnataka State in 2nd PU Commerce examination, 1st rank in Mysore University in BCom examinations, 47th rank All India CA Intermediate and 15th rank All India topping Karnataka State in CA Final. He has completed his articleship in PwC and he has done his industrial training in Hindustan Lever. As a chartered accountant for 14 years, he has specialization in taxation matters, and he is practicing as advocate in Karnataka High Court. With this very brief introduction, I welcome you for today's program, sir. Once again, hearty welcome to you.
Over to you, sir. You need to unmute, sir. You are on mute.
Yes. Are you able to hear me now?
Yes, yes.
So thank you, Mr. Shetty, and thanks, Divya, for introducing me. And I would also thank Bangalore branch for giving this opportunity to discuss the issues concerning permanent establishment. And it's indeed a pleasure to be with you again. Just about a couple of weeks before, we had this some sort of a brain trust on direct tax issues, particularly the domestic taxation concerning partnership, etc. And congratulations to Bangalore branch for having very successfully completed the program on domestic taxation and having now started this series on international taxation, and time couldn't have been more apt, to have chosen topics like these with the developments, that are happening, as the participants may have noticed in the recent past. You have the developments in the digital economy. You will have the Pillar 1, Pillar 2. You will have the Article 12B of UN model. You will have the action plans in the MLI. You will have the latest G7 proposals to have the global minimum tax. So the developments in the arena of international taxation are, far and many. And while it's seldom possible for one to be in the thick of all these, it's important that we'll have to try ourselves to be as conversant and as comfortable as possible with these developments, so that we would be able to face the challenge when the situation arises. Permanent establishment is a complex topic, and no amount of time would be sufficient to cover this topic, and it could go on and on. And there are a lot of associated issues relating to permanent establishment, and there have been commentaries on this in various manifestations of permanent establishment. And there are proposals to have virtual permanent establishment, because hitherto the traditionally known permanent establishment required a physical presence. With all its elasticity, it still insisted on physical presence. Now you do not know, a time may come where a virtual PE is also a possibility, and it's for this reason that we had to be abreast ourselves with the developments that are happening in this area. But larger part of today's discussion would be on the basis of what exists at present, and we would not hypothetically think as to what kind of virtual PE we would have, and get into discussion on a topic which is yet to come. But it's important that we'll have to be mindful of the fact that that also could be a reality. Now, if you would look at, if you would seek for the meaning of PE, you would basically find that in Article 5 of the Double Taxation Avoidance Agreement, as you would know. But now that MLI is in place, multilateral instrument in place, and India has already filed, the ratification documents, and effective 1st of April of 2021, about 40-45 states with India, the double taxation avoidance agreements, have become part of MLI. So as you would try to look at the meaning of permanent establishment in terms of Article 5 of any particular applicable double taxation avoidance agreement, you will have to remember that these could have been amended by MLI Articles 12 to 15. You will have to see the country's position with the respective other country with whom you're examining the DTA of, and whether these two countries together have adopted MLI 12 to 15. From Indian perspective, it has adopted MLI 12 to 15 completely. You'll have to just examine whether the other country also has adopted these, articles. If yes, then you'll have to understand the Article 5 of Double Taxation Avoidance Agreement as suitably amended by MLI 12 to 15. So for this purpose, what you may do is either you yourself sit and stitch it as to how the MLI would apply. Alternatively, you could even go for synthesized text that is made available by the CBDT in this regard. So the synthesized text with respect to these countries which are where the DTA stand amended are published by the Central Board of Direct Taxes. That would also help you in understanding to what extent the definition of permanent establishment as given in Article 5 of the Double Taxation Avoidance Agreement stands amended by MLI 12 to 15. If time permits, I'll very briefly take you later on as to what extent and in what manner do MLI Articles 12 to 15, modify Article 5 of the Double Taxation Avoidance Agreement. This is as far as DTA is concerned. Now, when you come to Income Tax Act, it is not that PE is a stranger to Income Tax Act. Even in Income Tax Act, there is a reference to PE. For example, if you go to section 44 DA, so there the PE is defined as a fixed place of business through which the business of the enterprise is wholly or partly carried on. What is the relevance of PE for the purpose of section 44 DA? We will see a little later. And even section 92F, which comes as part of transfer pricing provisions, 92F would also define what an enterprise is. And as it defines what an enterprise is, it says enterprise includes a permanent establishment. And if you would go to section 915, which will deal with the interest income, you will have explanation 1 again and explanation 2 there again would make reference to a permanent establishment. So at several places in the Income Tax Act, for example, if you go to section 10(4) capital D, there is a reference to permanent establishment. At several places, you will find references to permanent establishment. That apart, we have Deshi version of permanent establishment. What is this Deshi version of permanent establishment, which we call it as business connection? So you will find this business connection, as a taxing factor in terms of section 911. If you go to explanation 2 to section 911, it talks about the agency business connection, where there's an agent of a non-resident in India who would play the principal role in concluding contract for that non-resident, or he would habitually conclude contract, or he would habitually hold stocks, or he will habitually secure orders wholly or almost wholly for non-resident. In such case, it triggers what is called as agency business connection, which is almost identical to DAPE, dependent agency permanent establishment. So there are some differences, but subject to some differences, explanation 2 to section 911 brings one manifestation of permanent establishment. That's called DAPE. That apart, the more latest development through Finance Act of 2020, of course, this was started off in 2018, but became, more embedded into Income Tax Act by Finance Act of 2020 is explanation 2 capital A, significant economic presence. Here, hitherto, we've had the situation of people doing business in India would possibly have suffered taxes. If you look at explanation 2A, significant economic presence, it seeks to tax people who are doing business with India, not business in India. They're doing business with India. The transactions which are carried out in respect of goods, services, or property with any person in India, or download of data or software in India, the aggregate payments would exceed 20 million rupee, or rather rupees 2 crores, or systematic and continuous soliciting of business activities, or continuous interaction with 3 lakh or more users in India would trigger something called as significant economic presence. So this is what I was trying to tell you, that the Income Tax Act has gone a step ahead of the Double Taxation Avoidance Agreement and has already considered some sort of a virtual PE. So the virtual PE, which worldwide people are still exploring, India takes pride in having already put this virtual PE position in its domestic taxation and is just awaiting the OECD and other world bodies to accept it so that it will also get amended in the double taxation avoidance agreement, whereby virtual PE could be a reality. So this explanation 2A is a very, very important development in the Indian field, and it has brought in some sort of a virtual PE kind of a thing. But it is not found in the double taxation avoidance agreement as it, because there's no consensus worldwide as to how and in what manner one should have the virtual PE. We'll look about the interaction of this SEP, business connection PE a little later. But you have to be aware that in the domestic tax front, we have had significant amendments here. And the amendment in the domestic tax front in the context of virtual PE is much ahead of the double taxation avoidance agreement. Now, if you look at the meaning of a permanent establishment, as I've said earlier, Article 5 of any particular treaty would define what a permanent establishment is. This definition in the double taxation avoidance agreement is exhaustive, in the sense it would tell you 1, 2, 3, 4, 5. These are the permanent establishments. That's it. Anything which is not found in Article 5 is not a PE, or anything which is short of the parameters laid down in Article 5 would not be a PE. So that means PE is understood in an exhaustive sense. However, Supreme Court in Morgan Stanley in 292 ITR 416, as it appreciates that the double taxation avoidance agreement understands PE in an exhaustive sense, it went one step ahead to understand that Income Tax Act understands PE in an inclusive sense. So it got carried away, with due respect to Supreme Court, by the definition of PE in section 44DA, where the language is permanent establishment includes a fixed place of business in which the business of the enterprise is carried wholly or partly. Because the word includes is used, Supreme Court went on to say that it's an inclusive definition under the domestic tax law, and it would cover not only a fixed place, it would also cover service PE, agency PE, software PE, construction PE, etc. Which according to me is not correct, for the reason that all the service PE, agency PE, construction PE, which are found in different subarticles of Article 5 of the DTAA, give some specific yardsticks, objective parameters, upon which basis one could say that there is a service PE, there is a project PE, there is an agency PE DAPE. Now, in the absence of any of these objective parameters, when you would look for meaning of PE within the Income Tax Act, apart from a fixed place, anything else cannot be called as a PE. Otherwise, it will amount to what is understood in an agreement with a country, which would have applied only with reference to this country and that particular country where the agreement would have been entered into. That understanding is made applicable to the whole of the Income Tax Act and all the persons who are subject to taxation, whether or not that particular agreement would apply or not. This will amount to overstretching of a particular agreement with a particular country to the rest of the Income Tax Act, which according to me is incorrect. And therefore, we'll have to understand that the statement of Supreme Court that the PE, according to Indian Income Tax Act, would include service PE, agency PE, software PE, construction PE, etc., could at the most be an obiter, because it is unworkable and unimplementable. So it's impossible for it to determine under the Income Tax Act how a service PE would exist, how software PE would exist. So therefore, to the extent the Supreme Court has said that the definition of PE is inclusive, with due respect to Supreme Court, is not only incorrect, but also not workable and cannot be implemented. Now, what is the relevance of PE? See, we have to understand PE, and as I said earlier, see, permanent establishment discussion would entail, coverage of too many topics. So we would not be able to cover all these aspects in today's session. But what is important for us to know here is the relevance of PE, the interplay of PE with the domestic tax provisions, and to the extent time permits, get into the concepts of different manifestations of permanent establishment. Now, if you see here, what is its relevance from the Income Tax Act? See, from the Income Tax Act, it largely applies in the context of royalty and fees for technical services. You would know that royalty and fees for technical services for a non-resident would be charged to tax at a concessional rate of 10% under Section 115A 1B, within brackets capital A, within brackets capital B, on gross basis. So you don't get any deduction. Of course, you'll have to pay a surcharge and assess, as the case may be. However, if it is found that you have a non-resident has a permanent establishment in India, and his income by way of royalty or fees for technical service is effectively connected to that permanent establishment, that is where you have Section 44DA, which will come into place. So when 44DA applies, a non-resident has a permanent establishment in India, and the royalty income which he has, or the FTS income which he gets, if this income is effectively connected with the permanent establishment which a non-resident has in India, then you'll have to understand that 115A, which will provide for a concessional tax of 10% on gross basis, would not apply. You have to compute the income of royalty, you have to compute the income of FTS as if it were business income on a net basis, whereby you are allowed all the expenses incurred in respect of that permanent establishment as it would relate to earning this royalty and FTS. You will compute the net income, and on the net income, you will have to pay the tax rate which is applicable to you. If you are a non-resident company, in other words, if you are a foreign company, your tax rate could be as high as 40%. So that is where the PE is relevant even for domestic taxation. Even when you are dealing with domestic taxation, you're not dealing with a double taxation avoidance agreement only within the income tax. Even then, existence of PE is relevant for determination of tax on royalties and fees for technical services. Now, from the double taxation avoidance perspective, DTAA perspective, how and why is it relevant? Now, if you do not have permanent establishment, you may have income from royalty or fees for technical services. It would be charged to tax again at a concessional rate on gross basis, similar to domestic tax, except that the rate could be different. For example, the domestic tax rate is 10, surcharge and cess would be there. The treaty rate may be capped at 10. It may not exceed 10. So when a treaty rate applies, it may not include, there may not be a separate surcharge and cess. So that is when you don't have a permanent establishment. Or when you have business income and you don't have a permanent establishment, you don't have to pay tax in India. So this is where your not having a PE in India would decide where and how you pay tax. If it were business income, you don't pay tax. If it is royalty and FTS, you pay concessional tax. On the other hand, if it is found that you have a permanent establishment in India, then your business profits, which are attributable to a permanent establishment in India, will have to be suffering tax in India. At what rate? The rate would depend on who you are. If you are a foreign company, 40%. If you are an individual based abroad, you could be paying tax at 30%. So depending on the tax personality, the tax rate would be there. So when you have a business, when you have a PE and your business income is attributable to PE, you will have to pay tax. You have royalty or your fees for technical services, and they are effectively connected with your PE, then it would not be treated as royalty, it would not be treated as FTS, it would rather be treated as business profits. Similar to what would have happened in the Income Tax Act when there is a PE and your royalty and FTS are effectively connected with the PE in terms of Section 44DA, which we had discussed a little ago, would apply, except that Article 7 of the treaty would apply. Similarly, when you have independent personal services, so you have Article 14, Article 15 of certain treaties will have independent personal services, the services of a doctor, accountant, architect, etc., would ordinarily be not charged to tax, except when he has a fixed base available to him. The fixed base is nothing but the nothing but another manifestation of permanent establishment. So when you have independent personal services income and you don't have a fixed base, you don't have to pay tax in India, except when that independent personal service could also be called as fees for technical services. But when there is a separate article of independent personal services in the treaty, it will not be treated as FTS. And if you do not have a fixed base, you don't have to pay tax in India. Instead, if you have a fixed base, then it has to be treated as your business profits, and Article 7 will apply. So this is how the PE's existence is extremely relevant for the purpose of the taxation in India. Now, the whole scheme of permanent establishment and the definition of permanent establishment is basically some sort of an adjustment or an understanding between two countries, whereby they would say, ordinarily, we don't tax the business profits of resident of other state, except when the resident of the other state has put his foot into our soil. What do you mean by putting his foot into our soil? He has his, footfall here in terms of a permanent establishment. So if he were to have a permanent establishment, then his business activities and the income that would be earned from those business activities, to the extent they could be attributed to his footprint here, will have to suffer tax. So this is the relevance of PE. And as you would already know, the whole scheme of PE seeks to tax income from business activities, which have been carried out in India through a permanent establishment. Other incomes are kept outside the purview of permanent establishment, except where certain other incomes, as I've already stated, like royalty, FTS, or IPS, independent personal services, are effectively connected with a fixed base here or a permanent establishment here, whereby they partake the character of business activities per se, in which case they'll be treated as if it is a business profit. Now, once a non-resident is found to have a permanent establishment here, he is given the tax treatment which is same as how India would have treated its own residents. To give an example, let us say me and Mr. Shetty are the two enterprises. I am from India, I carry on some business here. Mr. Shetty is from Dubai. He has had a permanent establishment here. So once he has had a permanent establishment here, and once it's found that he also has to pay tax in India in respect of his business profits attributable to permanent establishment in India, then India cannot treat me and him differently. So all the deductions which are available to him in computing business profits should also be made available to Mr. Shetty. If I've had a loss, I'll have the benefit of carry forward of loss. If Mr. Shetty were to have a permanent establishment here and he will suffer a loss, then that loss also will have to be allowed to him to be carried forward. This is what Mumbai Tribunal in Lloyd's Register has stated. All the benefits, I may get various deductions, he also should get. If the country would not give him the deduction which I am eligible, or if country would treat him different from me, then it will amount to discrimination, and it is open for him to challenge that the treatment by India, which will amount to discrimination, will have to be undone. So you have the ruling of authority for advance ruling in 143 taxman 71. You have the European Commission decision in Saint Gobain's case, which is dated 2nd September 1999. Worldwide it is stated that wherever a non-resident is found to have a permanent establishment in a particular jurisdiction, such jurisdiction should not cause any discrimination to him. Now, as we move further down, see, you would find when you look at the PE definition in the treaty, some treaties you will find definition is narrower, where in less number of cases PE will trigger. Whereas in some treaties, you will find definition is broader, whereas in more number of cases, the PE will trigger. So what is the rationale? What is the arithmetics of this? If you find the PE definition is narrower and narrower, it will mean what? It is always favoring the state of source, or rather state of residence. It would not favor the state of source. I'll give an example. Let us say Mr. Shetty is from UAE. So what is the state of residence? UAE. He has some business activity in India. So what is India? State of source. Now, if the PE definition is narrower, not many cases his activities would constitute PE in India, which will mean India cannot tax. So it works adversely for India. It works adversely for UAE, that is state of residence. This would encourage international trade. More and more would want to do business in India because they will find that they needn't pay tax because PE definition is very narrower. So in less number of cases, they have to pay tax in India, which will mean more and more entrepreneurs across the globe would be wanting to do business with India. So India would be viewed as a tax haven if it does not create a PE for them. So it works fine. However, when India and the other country, we have a good trade balance and the capital account balance. However, as it will affect India's taxing position, India would be intending to make the definition of PE as broad as possible. So they find that every time Mr. Shetty does business in India, they would wonder, whether it will create a PE in India so that India can go and tax Mr. Shetty. So that is where India, it all depends on your negotiating ability with the treaty partner. So when double taxation avoidance treaty is entered into, in the negotiating table, how strong are you? So stronger you are, you will put for a broader definition of PE. Weaker you are, or more desperate you are for that overseas business, you will, give up your adamancy on PE, and you would agree to the other country's request that the PE definition will have to be narrower so that it will favor the other country, which will encourage other country to pump in good amount of capital here. However, if you are stronger, if you would need more and more taxes for developing your economy, you would then insist, no, I would not agree for narrower definition of PE. PE definition will have to be broader. That is when you will find you will have different manifestations of PEs coming in. DEP will come in, service PE will come in, project PE will come in, and in future, virtual PE will come in. So larger the definition, the broader the definition, there are more and more chances for non-residents activities in India to be trapped into permanent establishment. That would also protect domestic trade, because you would find that the non-residents would not be very excited to do business in India if he has to pay a good amount of taxes, which will mean he will think twice. So that would work in favor of domestic trade because they will not have overseas competition coming into them. However, the flip side of this is it will discourage, flow of capital. It will discourage flow of trade from developed countries. So this is the arithmetics of why in some treaties you will find PE definition is narrower, and in some treaties you will find PE definition broader. Now, next important point is, should a PE exist in the year in which you have to pay business income? For example, you may have PE in year 1, but no income at all in year 1. In year 2, you may not have PE, but from your PE of the past year, some income may come. In year 2, when you have to pay tax, there is no PE at all. So interestingly, you have Section 911 of Income Tax Act, income from or through the business connection in India. Now, when it comes to business connection, the courts are saying that the business connection need not exist in the year in which the income is charged to tax, as long as the income is accruing or arising directly or indirectly through or from business connection. Then place of taxation is decided. You'll have to pay tax in India. For example, if business connection existed in year 1, no income is earned, fine, no tax. In year 2, there is no business connection, but because of business connection of year 1, some income will accrue to you in year 2. then though in year 2 you don't have business connection, you have to pay tax under Income Tax Act. Whereas this is not the position when it comes to permanent establishment, because the Delhi High Court in E-Funds case 364 ITR 256, as affirmed by Supreme Court in 251 Taxman 280, it hints that in the year in which you have to pay tax on business profits, that year only PE should exist. If the PE would not exist in that year, you don't have to pay tax. For example, if you go to the protocol of the Indo-US Treaty, if you take Indo-USA Treaty, look at Article 5 and look at Article 7, there's a protocol. There is a special clause saying that even if the PE ceases to exist, if there is any payment is so arranged to come to you after the PE has stopped, then they say you still have to pay tax. It is similar to the Indian tax position of income accruing or arising through or from a business connection. What I'm saying is, when it comes to DTAA, this requirement is not there. Wherever this requirement is there, specific agreement would have been entered into, like Indo-USA. This kind of agreement is not found in all the states. Only in Indo-USA they've agreed that even after the PE will cease to exist, if any payment is relating to the PE but comes much later after the PE has stopped, even then it has to be attributed. This is a very, very special and a unique case. You don't find this kind of an agreement in other treaties. So the logic and the point which I'm trying to drive is, when it comes to the double taxation avoidance treaty, existence of PE in the year of taxation is a must. If in that year no PE, no tax at all, wherever there is an exception intended, specific protocol would have been agreed. In the absence of protocol, no PE means no tax. Now, look at this example here. So I'm just giving you a very small example just to drive this home. Take year 1. There is a business connection in India. Yes. Is there a PE in India? No. In that year, no income accrues from business connection. There is a business connection, but no income accrues. No PE also. So obviously, the result is what? In that year, you don't pay tax. Now go to year 2. In year 2, there is no business connection. There is no PE, no income accrues. The answer is obvious. You don't pay tax either under the Income Tax Act or under the treaty. Now you go to year 3. In year 3, there is no business connection. There is no permanent establishment. However, in year 1, you had a business connection. From that business connection, some income accrues to you in year 3. Now, what is the position? Look at this. Under the Income Tax Act, as I've said earlier, in the year of accrual of income, business connection did not exist. It is enough if the income is related to the business connection. It is found that the income which you get in year 3 is related to the business connection of year 1. And therefore, under the Indian Income Tax Act, it is deemed to accrue or arise in India. However, you can overcome it. How? In that year, there is no PE at all. So you would say, because there is no permanent establishment in year 3, I will not go by Income Tax Act in terms of section 90 subsection 2 on the basis of decision of Supreme Court in Azadi Bachao Andolan in 263 TR 706. I will rather go to the treaty because treaty override will exist. And according to treaty, if I don't have a PE, you can't tax me. So this is how, you can play with business connection position and PE position and avoid the tax in all the years. So this is just a very small example to drive you home the point of whether the business connection should exist in the year of taxation versus whether PE should exist in the year of taxation. Now, see, there are two things here. One is understanding what a PE is, when a PE would exist. But that understanding would not suffice unless you would also understand, should a PE exist? How is the income determined? See, actually, it's an easier challenge to determine whether a PE would exist or not. The greater challenge is determination of income attributable to PE. So, in fact, of course, you will have Mr. Dhinal Shah who would come and explain to you possibly as to how the attribution principle will have to be applied. I would only very briefly, touch upon which are the sections, which are the provisions you will have to look at whenever there is an attribution, because without the business income attribution, PE definition doesn't make sense. So ultimately, India would want to tax what? Business profits. What business profits? Business profits which are attributable to PE in India. So now let's look at this. Look at the Income Tax Act itself. So you have the attribution happening both under Income Tax Act as well as under DTAA. Let me just take you through the provisions of Income Tax Act which will deal with attribution. See, under Income Tax Act, the Deshi permanent establishment is called the business connection in India, Deshi version of permanent establishment. So whenever there are different types of permanent establishments in India or business connections in India, one is generic business connection. One is significant economic presence, that is virtual PE kind of a thing. Third is a situation where you have agency business connection. Now, depending on which type of business connection you have, the income attribution will take place. For example, you are having a generic business connection. Under section 911, what it says, income accruing or arising directly or indirectly through or from a business connection is deemed to accrue or arise in India. But how to compute it? Then you have explanation 1 within brackets here. It says, where not all operations are carried out in India, the income which is deemed to accrue or arise in India from business connection shall be only so much of the income as may be reasonably attributable to operations in India. Then explanation 1b says, no income shall be deemed to accrue or arise through or from operations which are confined to purchase of goods in India for the purpose of export. So like this, you will have various explanation clauses to explanation 1. Then you have explanation 3a, which will say these have to be necessarily attributed. What are these? Advertisement income, which will target the Indian audience. All advertisements which will target the persons who reside in India or target the persons who would access internet through the protocol address provided in India, made available in India. The sale of data collected from persons who reside in India, sale of goods on the basis of data collected from persons residing in India. So look at the attribution that is happening here. So you will have serious issues arising when this explanation 3a is implemented, because FA 2020 has implemented this explanation 3a into the Indian law now. So the moment you have a business connection, you will have attribution of advertisement revenue, you'll have attribution of sale of data which you would have collected, you'll have attribution in respect of sale of goods on the basis of sale of data. You would have bought somebody else's data, would have ascertained who the Indian customers are, and would have then sold goods to Indian customers. Even though you may not be operating in India, you may still have to pay tax in India. So this is the reach of explanation 3a. And that apart, you will have rule 10 of IT rules, which will give some sort of Brahmastra to income tax officer. He will decide the basis on which you will have to. He will say 10% of the global profits will have to be deemed to be accruing or arising to you from business connection in India. The 10% could run into a few hundreds of crores. For him, it is easy. When one stroke of pen, he'll do it, and you will have to litigate it. And you will have section 92CC, advanced pricing agreement has come in now, even to determine how much of income is to be attributed, in what manner income has to be determined. That has come now. And Finance Act of 2020 has amended section 295, subsection 2, permitting the Central Board of Direct Taxes to make rules. They have brought in clauses 2A and 2B, subclause 2A and 2B to subsection 2 to section 295, permitting CBDT to bring out the rule, prescribe the methodology as to how the income attribution will have to take place. Now, we are yet to get the rules. Rules are awaited, and once the rules would come, you can only imagine what kind of weapons with the department would have the moment you are found to have a business connection in India. Similarly, when like you have a significant economic presence, virtual PE in India, through explanation 2 capital A, same whatever I've explained earlier would also apply. And please understand one thing. If you are found to have a virtual business connection in India through explanation 2A, even if you sleep with your head towards India, you may have to pay tax in India. In other words, all your business with India, you will have to pay tax. See, there is a difference between business in India, business with India. Business in India means you will come to India and carry out the activities. Business with India means you will not even visit India. In your country, you carry out activities. You will have Indian customers. So because of explanation 2A, virtual PE concept, you have to pay tax in India even when you don't carry out any activity in India. So this is the effect of explanation 2 capital A and the attribution aspects that will take place. The other one is the agency business connection. You have explanation 3 to section 911, which says the income that is to be attributed will have to be confined to the activities of an agent in India. This is as far as Income Tax Act. Now go to the case of double taxation avoidance agreement. Under the double taxation avoidance agreement, if you are found to have a permanent establishment in India, then you are liable to pay tax in India to the extent of your business profits attributable to the permanent establishment. Then you'll have Article 7.2 which will come into place. What does Article 7.2 say? It says the profits of the PE in India will have to be computed as if it were distinct and separate from the enterprise of which it is a PE. That means a fiction is created whereby the permanent establishment here is treated as a separate person. Once it's treated as a separate person, we'll have to carry out a separate FAR analysis, functions, assets, and risks analysis, like what you would do in transfer pricing. So it's a different matter as to whether the PE and the non-resident are associated enterprises, and therefore section 92 of chapter 10 would apply or not, is a different thing which we'll not get into at this point in time. There's one more concept called force of attraction, which also will have to be kept in mind. What is this force of attraction? Many countries, what they do is, many enterprises, what they do is, they will have a PE in India, but keep the role of PE very limited. Actually, they use the PE's positioning. They rather make the direct sales. Take a case, Mr. Shetty, our chairman, is from Dubai. He will have business in Dubai and he has a permanent establishment in India. So using the permanent establishment in India, he would have developed all the contacts, but he will never sell the goods through permanent establishment. He will make direct sales. Because if he were to make sales through permanent establishment, he has to pay tax in India. So what he will do is, he'll say, okay, only in respect of profits of PE, I will pay tax in India. He'll keep the turnover of PE very limited. Rest of the goods he will supply directly from Dubai to customers in India. So therefore, some countries with India have agreed we should not allow this to happen and have brought in the concept of force of attraction. Under force of attraction, they'll tell Mr. Shetty, look, we don't care whether you have sold goods through PE or you have made direct sales. Do you have a PE in India or not? If answer is yes, we'll attribute to the PE profits not only of the sales made by PE, but also the direct shipments which are made to Indian customers will also be treated as deemed to have accrued and arisen from the functioning of the PE in India. So this is called the force of attraction. You don't find this force of attraction in all the treaties. You will have, detailed force of attraction like what you have in Indo-US Article 7.1c. You will have limited force of attraction in some other treaties. In some treaties, you may not have force of attraction at all. Then Article 7 sub-Article 3 says, how do you determine the profits? They say all the expenses will have to be allowed as deduction in computing profits of the PE. Expenses need not be incurred in India. Even the expenses incurred overseas, to the extent it is reasonably allocable to PE, will have to be allowed as a deduction. And hence, PE profits will have to be determined. Now, the question for consideration is, you are found to have a permanent establishment. your profits will have to be attributed. Can they use the Income Tax Act provisions? Like I told you, Rule 10, I told you explanation 3A, which will talk about the ad revenue, which will talk about the data revenue, etc. Could all those be implemented and attributed even under the treaty? Is the question. The reason is some of the treaties provide that the determination of profits of PE may be based on a method of estimation as may have been provided in the Act, provided the result is in line with what would have been the case had you determined the profits of the PE on a standalone basis on a reasonable manner. So therefore, the question that arises and the dispute that could possibly arise later on is, can the department use the expansive factors of explanation 3A, etc., even for the purpose of profit attribution to PE? Is a question which is open, which the delegates will have to think over. And it's possible to defend that explanation 3A is part of Income Tax Act. It cannot be implemented in the treaty attribution unless the Article 7 provides for it. You have all these differences, but you cannot rule out, knowing the aggressive attitude of the income tax officers, that they may invoke this as well one fine day. Then Article 7.4. Article 7.4 could provide some limitations, like expenses may be allowed while computing profits of a PE, but then subject to and in accordance with the provisions of the domestic law. For example, you have 40A1, you have 43B, you have 40A3, you will have section 44C, which deals with head office expenditure ceiling. So these are all the limitations provided from within the Income Tax Act. So DTA itself will provide, okay, you are a PE, fine. When you attribute your profits and allow you expenses, we will have to allow the expenses provided you comply with the domestic tax law. So all your 40A1 deduction, disallowance, 40A7, 40A3 cash payments, all these could as well apply to the PE. So their ability to claim expenses would depend on their compliance with the domestic tax law. So this is how they interlink the provisions of Income Tax Act and the treaty attribution rules. Now, look at a couple of decisions like ZT Corporation Delhi Tribunal, Consulting Engineering Corporation Delhi Tribunal. The Delhi Tribunal has held that Rule 10, which the income tax officer uses for Section 911, could also be used in the context of PE. So there are decisions. So tomorrow, Income Tax Department says, okay, Tribunal has upheld the use of Rule 10. So why not explanation 3A? So why not target income like sale of advertisement targeting Indian audience, sale of data targeting Indian audience, sale of goods using the data collected from Indian audience. So department would be encouraged on the basis of these decisions to apply the domestic rules for the purpose of profit attribution to PE. Now, one another important aspect of PE is, Income Tax Act versus equalization levy. See, nowadays, equalization levy has assumed a lot of importance. Particularly, you will have, like Finance Act 2016, which introduced equalization levy at 6% in a limited manner on specified services in terms of Section 165, subsection 1 of the Finance Act. Finance Act of 2020 amended the Finance Act of 2016 by introducing Section 165A into that Act to provide for equalization levy on e-commerce supplier services. So now you have two types of equalization levy. We'll call it an EL1 and EL2. EL1 is specified service. EL2 is e-commerce supply and service. Now, what is the relevance of PE when it comes to equalization levy? So relevance is seen in this chart. Look at this chart. Do you have a PE in India? If you have a PE in India, you don't have to pay equalization levy at all. Because your PE would capture the income. that would arise from the specified services as well as that would arise from e-commerce supplier services, and you would be paying the taxes in India under the Indian Income Tax Act. If you don't have a PE in India, but you have income by way of specified services, or you have income from e-commerce supplier services, then you are liable to pay equalization levy. If you are liable to equalization levy, you don't have to pay income tax under section 10 within brackets 50 of the Income Tax Act. So therefore, your existence or otherwise of a PE is important and relevant even from the point of view of your liability to EL is concerned. Now, I'll explain this in little more detail. Let us say you are a non-resident. You are providing specified services under section 165(1) of the Finance Act of 2016. What is specified service? Online advertising is a specified service. What is the levy? 6% of the consideration what you receive on online advertising as per the Finance Act of 2016. Now assume that Mr. Shetty is a non-resident. He is getting consideration in respect to specified services. Now, is he liable to income tax or is he liable to equalization levy? Now we'll look at this. Firstly, come to income tax. Does he have a business connection in India? If the answer is yes, don't stop there. Then check whether he has a PE in India or he doesn't have a PE in India. If he has a PE in India, then he has to pay tax in India because there is a permanent establishment and he is liable to pay tax. Because he has PE in India, he is not liable to EL. This is one situation. Now come to another situation. He has a business connection in India. Yes. Does he have a PE in India? No. Is he liable to tax under Income Tax Act? Because he would say, I will not pay tax because I don't have a PE in India. I will go by treaty. Under treaty, I am liable to pay tax in India only if I have a PE in India. So he would not pay tax in India because he does not have a PE in India. But because he is providing specified services, he has to pay equalization levy. Come to the right-hand side. Does Mr. Shetty have a business connection in India? Answer is no. Don't stop there. Does he have a PE in India? In a very remote situation where even if you don't have a business connection in India, you must still have a PE in India. Let us assume he has a PE in India. If he has a PE in India, he will still say he will not pay tax in India though he has a PE. You know why? Then he will say, I don't want treaty. I would rather want to stay with the Income Tax Act. According to Income Tax Act, I don't have business connection. Because I don't have business connection, I don't have to pay income tax in India. I don't want treaty at all. I will take the treaty only if it is beneficial. Section 90, subsection 2 of the Income Tax Act, where you have a choice of the treaty or Income Tax Act, whichever is beneficial to you. Because in this case, he doesn't have a business connection. He is not liable to pay tax on the business profits in India. And just because he has a PE, he can't be forced upon to use the DTAA. DTAA cannot be more onerous on him. So he will say, I will not pay income tax under the domestic law. I don't want the DTAA. But it is found that he has a permanent establishment in India. Because he's a PE in India, he is not liable to pay equalization levy. Because the moment you have a PE in India, you're not liable to equalization levy. Now come to the other side. He has no PE. He has no business connection. Definitely there is no income tax. But because he has no PE, he is liable to pay equalization tax. So please understand this chart as limited to Mr. Shetty, who is providing online advertising as a non-resident. Don't generalize this to all activities. I am only trying to give you an interplay between Income Tax Act and the equalization levy and the scope of permanent establishment in deciding whether you are liable to pay equalization levy or you are liable to pay income tax under the Income Tax Act. So you cannot generalize this chart. I'll repeat again for all other purposes. Whatever I am now exhibiting and displaying here is only for the limited purpose of specified services, which is online advertising, which is chargeable to EL under section 165(1) of the Finance Act of 2016. Now, let's go to the next aspect. EL2. What is EL2? Finance Act of 2020 introduced equalization levy Avatar 2. This is in respect of e-commerce supplier services. In e-commerce supplier services, an e-commerce operator is liable to equalization levy at 2% in respect of consideration which he receives in respect of e-commerce sale, e-commerce provision of services, e-commerce facilitation of sale or provision of services by somebody else, or a combination thereof, or a combination of any of these. So, therefore, you also will have to understand the interplay between equalization levy and income tax on the same lines, like what I've explained in the context of specified services. Same chart is just the same. So this will give you some sort of a relevancy of PE even while determining the liability to pay equalization levy. Now let's come to the type of like permanent establishments. Typically, when you, of course, this Article 5 and sub-articles cannot be generalized. It will depend on the particular treaty. For example, you have 5(1), which is generally the same in all the treaties. Fixed, what is PE? Generic PE, permanent. What is permanent establishment? The fixed place of business in which the business of the enterprise is wholly or partly carried on. Then 5(2) will give you an extended, a meaning of PE, like a branch, an office, etc., a warehouse. 5(3) will give you that, okay, even if you have a fixed place of business, some of these activities are exempt. If these exempt activities are carried out, it would not trigger a PE for you. 5(4) will deal with dependent agency, permanent establishment. Now just look at this. For example, you look at 5(2), extended categories. It could be, as I've said earlier, a place of management, a branch, an office, a factory, a workshop, a mine, a warehouse, a building site, an exploration site, mining site, service PE, project PE, and this has to be understood along with MLI 14, depending on if that MLI 14 is applicable to your treaty or not. India has adopted MLI 14. So whichever country you're dealing with, you'll have to take the synthesized text with that country and find out if MLI 14 is made applicable. So in case you have a project permanent establishment and the double taxation avoidance agreement would say that the project will have to run at least for, say, 120 days as a cutoff for it to cause project PE. There is a tendency for a non-resident to split it between him and a related party. So he would do it for 90 days. His related party will do it for 40 days. So together it will exceed 120 days, but individually it will not exceed 120 days, which is the threshold. So this is called the fragmentation, a splitting of the period to avoid the PE. So MLI 14 will come in to say, no, in such case, if some conditions are satisfied, all the associated persons periods will have to be aggregated to see if the assessee has exceeded the threshold of 120 days or 6 months, as the case may be in the treaty. So when you examine this extended category, you will have to keep in mind MLI 14 also. Now we will have exempted activities. See, in order to encourage international commerce, they would have to ensure that sporadic activities, preparatory activities, auxiliary activities, which a non-resident will carry out here, should not entail taxation, because if every step he takes in India, he were to pay tax, he will not as well step into at all. So there has to be a limit up to which he should not face taxation. There has to be a tolerance band. So what is the tolerance band for a PE? That is found in Article 5(3). What do they tolerate? And hence they will say you don't have a PE even if you have a fixed place here. So tolerance could be where you use a place only for storage, display, or delivery of goods, or processing of goods. Or you keep a go down here only for purchase activity, or only for collecting information like license office, for just licensing purposes, only for advertisement. You don't do anything else. So that is the tolerance band. So if a non-resident were to have an office in India, and in that office he will confine only to these activities, then it would not mean a PE for him, because it will not trigger a PE. He will not be liable to pay tax. But then people have started, exploiting and abusing this. So storage and delivery. Nowadays, there was a time when the storage and delivery were not considered as economically significant activities. Now, if you look at Big Basket, if you look at Amazon, if you look at Flipkart, if you look at Alibaba, delivery and storage is a very, very significant activity. It is no more an activity of preparatory or auxiliary in nature. It is really value-adding economic activity. If that is done, then even though it is called as storage, display, or delivery, they'll have to pay tax here. That is when MLI 13 will come into place. What MLI 13 says is, though you may be carrying out these tolerable activities, see, these are all called tolerable activities. Okay, they are tolerable provided they remain as mutant activities, provided they remain as preparatory or auxiliary activities. But on the basis of nature of your business, if a storage activity cannot be called as a simple preparatory activity, but it is a significant economic activity, then we will not accept the tolerance band. We will consider that you have a permanent establishment in India. So that is where MLI 13.1, 13.2, 13.3 will come into play. Now, what people have started doing is, non-residents, they will have, one person will do storage, one person will do delivery, connected persons. So Mr. Shetty's, there are three brothers of Mr. Shetty, Shetty 1, Shetty 2, Shetty 3, all in Dubai. So they would want to do some activity here. If all these are done at one place, it will look like business. So what Shetty 1 will do, he will do one segment, which will fit into tolerance band. Shetty 2 will do in another segment that will also fit into tolerance band. Shetty 3 will do third segment. So they vivisect it or fragment this between their related parties, and then go and tell the income tax department, look, my activity only this, it will come within the tolerance band. So that they have found as very mischievous, and that is why they have brought in MLA 13.4. So MLA 13 subarticle 4, which India has accepted, will provide for aggregation of all the activities of Shetty 1, Shetty 2, and Shetty 3 to see whether together seen, are they still preparatory or are they constituting significant economic activity? When together seen, if they constitute a significant economic activity, then they'll make Shetty 1, Shetty 2, Shetty 3 pay tax on it. So this is where, when you examine Article 5.3 of the treaty, which will deal with the tolerance band, don't stay only with that. Look for the synthesized text published by the CBDT in connection therewith, and see whether MLI 13 is made applicable and examine it. So initially it will pose a challenge because the language of MLI is little complex. But I'm sure over a period of time, the chartered accountants are intelligent enough and hardworking enough to overcome the difficulty. Like when transfer pricing was introduced in 2000, many chartered accountants thought, okay, we will not be able to handle it. So whereas now I would see plenty of chartered accountants very effectively handling transfer pricing matters. So this also is a matter of time. So that is where I mentioned Bangalore branch has done a commendable job in, like having all these sessions brought in, so that the members of the Bangalore branch are kept conversant with the developments that are taking place in the recent past and equip themselves sufficiently strong enough to face the challenges that would arise over the years to come. Now, DAPE, Dependent Agency Permanent Establishment. So what is this Dependent Agency Permanent Establishment? So Mr. Shetty would want to do business in India. What he will do, if he sets up a shop here, he will get caught. He has to pay tax. He will not set up shop. He will appoint Chythanya as his agent. So what Chythanya does, he acts like a virtual projection of Mr. Shetty in India. Whatever Shetty would have done, Chythanya would do. So Chythanya is allowed to habitually conclude contracts, to secure orders, to hold stock for Mr. Shetty and do the deliveries wherever necessary as per his instructions. So this is called as DAPE. Then Mr. Shetty is deemed to have a permanent establishment in India through Chythanya, and the profits are attributed to it, and Mr. Shetty is liable to pay tax. Here again, you will have to see MLI 12. See, earlier law provided it's only when Chythanya is able to conclude contract, then it will trigger a permanent establishment for Shetty. So what Mr. Shetty did is, okay, Chythanya, I don't conclude contract. You do everything except signing on the dotted line, which I will do digitally from my Dubai office. Is there a big difference? Therefore, this is realized, and they have now said, I may not conclude the contract, but if I play the principal role leading to the conclusion of contract, if I play the principal role leading to the conclusion of the contract, then I trigger a P for Mr. Shetty. This is what is found in MLI 12. So therefore, whenever you look at agency PE, you will have to also ask for the synthesized text of, I know, like treaty as amended by MLI issued by the CPDT, and see whether MLI 12 is made applicable to that particular treaty. Look at the role of the agent. He may not be signing the contract, but he may be playing the principal role, significant role, leading to the conclusion of the contract, in which case it will be a case of permanent establishment. Now with this, let me go a little deeper. And before I go further, I could take some questions, Mr. Shetty, now, so that there is some time for interaction. Any questions so far? Are there any questions? Because I've gone for about an hour, and it's time possibly to take a pause for questions.
No questions so far, sir.
No question.
Any question directly come to you, Q&A?
No,
I can't see anything.
Okay, then no, if you can't see, I can't see.
Okay.
I'm your tape in India.
Yeah.
Yes. Okay, now
there is one question, sir. Q&A,
Yeah.
just now one has come. I think you can see that. I can't see fully.
Can you read it out, or can somebody read it out? Because just a minute.
Is EL not a treaty override?
Oh, I would not answer this question because this is a question beyond the topic. It will take some time to answer this question. EL is, okay, anyway, queries, because it's the first question, I should not disappoint. And queries should not think that I possibly don't know the answer, that I'm evading this query as well. So let me answer this question. See, EL is a treaty override. It's a unilateral action. In fact, there is a committee constituted by OECD and Action Plan 1. It's called TAFE, or rather TAD, Taxation on Digital Economy, where they have said that till such time a consensus is reached, countries can take unilateral measures like equalization levy, withholding tax, and significant economic presence, but they have to accept their treaty obligations. But there is a committee on digital taxation which gave a report in 2016. They wanted it to be specifically kept out of Income Tax Act, put it under equalization levy as part of Finance Act as a temporary measure, and the whole objective is to not to let it get overcome by treaty. So the objective is to have a treaty override, though it is not permitted by the OECD action plan 1. So right now it overrides the treaty as it stands now. Yes. Any other question? So I would request the queries to confine the questions to the topic of what we're discussing, so that we don't get diverted. No more questions?
One more, sir. Can you please give an instance of P without BC, business connection?
Okay. See, a service PE, for example, a service PE, there are provisions in the double taxation avoidance treaty where parties are connected and service is rendered even for a day. It would constitute service PE. Whereas a sporadic activity by itself would not cause a business connection. So this is a case where there could be a service PE, but there is no business connection. Yes.
Is there a formula to identify to select PE or EL to optimize the lower tax? It is from Girish CS.
See, there is no standard formula. I have given you one chart. Maybe you will have to play with the chart in a given situation to get an optimum level. So it all depends on what you are doing, what is your exposure, how much of taxes you would want to save. Is tax saving your primary criteria, or business expansion is the primary criteria? So a lot of factors will have to be kept in mind. And the chart which I have given you, the arithmetics between the EL and the Income Tax Act and the role of P which I have given, on that basis you will have to make permutation and combination and decide what is optimum for you. See, there is no suit all optimum. It is all tailor made. You don't have a standard plan which is applicable to all. Tax planning is always unique. Yes.
Next question. Can EL be claimed as foreign tax credit? And if yes, what document
outside
can be
the
produced?
Syllabus. Outside the syllabus. This session is not on EL, so I would request the queries again. Though I have mentioned EL, that is only for the purpose of, limited purpose of exhibiting the relevance of PE, which is the topic. So please refrain from asking questions other than relating to PE.
Yeah, I think we have a separate session for that.
Exactly. You need a separate session. In fact, Mr. Shetty, if I may suggest, you need a separate session on, like equalization levy and the e-commerce. You have to have a separate session.
Yeah.
And also on the digital commerce and the developments that are taking place in international, scene in respect of this area. Like it could be Article 12B of UN model. It could be the G7 agreement. It could be, the pillar 1, pillar 2 allocation. All this will have to be, brought out as a separate session. And maybe one on equalization levy. Yeah.
Yes, sir. We'll do that.
Yeah. Any more questions?
Yeah, that's all.
That's it. Okay, now we will move on to more detailed aspect of permanent establishment. I have some interesting cases also to digest here. Let's look at the generic PE, that is 5.1. Article 5.1 defines PE as a fixed place of business through which the business of an enterprise is carried on wholly or partly. So now this definition is identical, whether you take OECD model, UN model, US model, it is identical. Now, before we go in there, in order that you are a PE, it has to be a fixed place through which your business is wholly or partly carried on. Fixed place means, should it be an immovable property? Should it be something which is permanent and never-ending kind of a thing, everlasting? Should it satisfy a particular duration? These are the questions that would arise. So the worldwide, the commentators have stated that it need not be everlasting, and the duration or the situs, it will all depend on nature of business. If your nature of business is transient, temporary. Even your fixed place also could be just that, transient and temporary. See, it has to coexist. That's it. See, some business could be run just for 10 days. So there could be a fixed place for 10 days. So, for example, if you go to the decision of Supreme Court in Formula One, which I'll take you through a little later, where the Formula One race could be conducted for about a week. Could you have a permanent establishment? Is it permanent? Is it fixed? It would be so if for all the 7 days, you have a right of access to the particular place. So what I'm trying to say is, the word permanent is not an inflexible word. It is elastic. It has to be understood in the context of business, which is carried on in that fixed place. So that is why you will find, Fugro engineer's case, the Delhi tribunal beautifully says, no length of time is prescribed in respect of Article 5.1. In such a situation, if the place of business is available to the assessee for the period in which its independent work can be completed, it constitutes a permanent establishment. Now, what do you mean by a fixed place? First of all, as the very name contains in it, it has to be a place of business. And it will be called as your place of business if you have a right to use the place. What do you mean by right to use the place? You may enter as a guest. So, for example, let us say I have an office in Bangalore. Mr. Shetty is from Dubai. Whenever Mr. Shetty comes, he will just come to my office as a guest. He may come to my office, sit there, to consult with me. But he doesn't have a right of disposal in respect of my office. I will allow him to come as a guest. It is not that he need seek my permission every now and then. Like we have a wrapper whereby he can come in and go out. But that does not make my office his fixed place of business. By fixed place of business means he has a right which I can't stop him from coming in there. So if there is an agreement between me and him, whether in writing or oral, whereby whenever he visits Bangalore, he can walk into the office without any restriction whatsoever. There is a chamber which is available to him. He can come and sit. Whether office is closed, open, whatever, he has a key available to him, or a key is made available to him whenever he comes. Then it's said that in respect of that cabin, he has a right of disposal. ROD test is satisfied, and that could constitute his fixed place of business, and that could as well trigger a PE for him. Now, it need not necessarily be a building. It could even an equipment. It could even be an equipment or a machine or whatever. So what is important is business carried out there? Let us say there is a huge dispenser that is placed. What it does, like you have a note dispenser, you have, like a beverage dispenser, etc., where people can put in coin. They will have the, the beverage, like oozing out in the cup that they hold, and, they'll consume it. You will have seen it in all the airports, etc., railway stations, etc. Kiosks are maintained where they are self-running. They're all automated. But because the business is carried through the same, that would constitute a fixed place of business. So it need not necessarily be handled by men. It could even be without the human intervention. Now, see, there was a decision of authority for advance ruling in golf in Dubai in the context of a golf tournament. So there, the authority for advance ruling stated, they posed a question to themselves. Does the place of business support the business activity of non-resident? Or does the business simply occur at that place? So the alternate questions. If the business simply occurs, then that may not be a permanent place, a fixed place for him. Instead, the place of business support his business activity, then that would trigger a permanent establishment. Duration is not the criteria, and this is approved in Formula 1 as well. I'll take you through Formula 1 a little later. Very interesting, case study. Now, the place need not be necessarily owned. It could even be rented. An office, a mine, a factory, could all be the fixed places if these requirements are met. So there are some decisions here. If the earliest decision and the most beautiful decision in the context of this is the Visakhapatnam Port Trust case, 144 ITR, 146. And then you have, it has stated that what is a PE? It postulates the existence of a substantial element of an enduring or permanent nature of a foreign enterprise in our country. That would mean it's a PE for him. And in Ensco Maritime's case, the Delhi tribunal stated that, PE means what? It is some sort of a virtual projection of the foreign enterprise in this country, in the soil of this country. That would constitute PE. Morgan Stanley, some interesting, in 292 ITR 416, Morgan Stanley is one decision which dealt with so many aspects. One of the aspects is, there are some guys of Morgan Stanley Inc. who came down here and were carrying out some activity which are essentially back office operations. The question arose as to whether carrying out the back office operations amounted to a fixed place of business where the business is carried on. So what is the PE? PE is not just a fixed place of business. It's a fixed place of business in which the business of the enterprise is wholly or partly carried on. Here, there was a fixed place, no doubt. But what were they carrying on here were only back office operations, which the Supreme Court said is not the business operation. It is only a back office operation. It is preparatory operation. So by which you cannot say the business is carried on, and hence it would not constitute a PE. One of the latest decisions, 425 ITR 30, UAE exchange. UAE exchange, which is based in UAE, had a license office in India. What does this license of? What does UAE do? It will help money transfer, between the Indians who are settled in UAE and their families here. So people who go to Gulf essentially, remit the funds to their relatives here. So this is carrying out the function of, fund transfer. So there is a guy in, Gulf who would want money to be sent to his dad in Mangalore. So he will go to UAE exchange, put the cash there or cut a check or whatever. Then they will, do everything there, print a soft copy of the DD, and then transmit it to the license office here. So what the license office in India it will print this pay order or the DD, then engage a courier and send it to that person's dad in Mangalore. So that's the job which license office in India was doing. And department said, you're doing a significant economic activity of the other end of money transfer, because one end is handled at UAE from the remitter's point of view. From Indian end, Indian leg of this, money remittance is handled by license office. So it is not just the license function, it is a significant function and a PE triggers, and hence you are liable to pay tax. So matter goes to Supreme Court. Supreme Court relies on Morgan Stanley case earlier in 292 ITR 416 and concludes that what license office does here is only the limited function which it is permitted to do as permitted by RBI and the license office license granted by it. And it's only back office operation, and hence it would not constitute the permanent establishment. So you have so many other decisions. Now we will, it's 5:30 now, so I will take another 10 minutes. Before that, I would rather take some stray topics before I go to Formula 1. Now you may have various questions, whether website is a PE, whether a server is a PE, whether the satellite footprint is a PE. You'll have a lot of these questions. Supreme Court in Formula 1 agreed with Klaus-Vogel's comment that the mere website would not constitute a PE. However, if the website is hosted in a server which is in India, and if the business is carried on through the website, that would possibly trigger a PE in India. As regards the website, whether it will constitute PE or not, there is a disagreement between India and OECD. While OECD says it is not PE, India says it's PE. As regards satellite footprint, OECD says it is not a PE, India says it's a PE. When it comes to service PE, OECD says in order that a service PE triggers, it is essential that there has to be provision of service carried out in India. People have to visit India and provide service here. Whosoever may be the beneficiary of service, that is not relevant. The situs of rendition of service will have to be in India, is what OECD says, but India disagrees with this. But then, in E-Fund's case, Supreme Court would not agree with India's position. In E-Fund's case, Supreme Court endorses what OECD has said, that in order to constitute the service fee in India, it is essential that the services are provided within India. Whosoever it may have been provided, the rendition of service will have to take place within India. So when it comes to the website, as I've said earlier, the Supreme Court in Formula 1 has agreed with Klaus-Vogel to say that the website would not constitute a PE in India. As regards satellite footprint, right now, the Indian judiciary is of the view that it would not constitute a PE in India. So whatever India may have reserved of its, India's reservations would not carry any weight, because this is what the Supreme Court has said in latest decision in 432 ATR in engineering analysis case, the famous software case. They have said that your reservation by is not a law. Reservation is your opinion. So we will still go by OECD if that is the universal law of the world, unless there is a law in the country contrary to it. So now with this, I will, Mr. Shetty, I'll take about 5 minutes. So
Yeah, you can take
Yes, sir.
another 10 minutes. 10 minutes.
10 minutes. Are there any questions? Because I don't think this will get over. Though if there are no questions, I'll proceed with this. Are there any questions, Mr. Shetty?
It's all answers.
Yeah.
We can take 10 minutes break and come back, sir.
No. I would have to quit after I finish. I will not come back. So
Okay.
no, I will continue for another 10 minutes if
No, one question,
Huh.
whether BPOs of foreign companies are not PE?
BPOs of foreign companies. No, question is not clear.
Yeah.
Do the foreign companies have an office here or subsidiary here? See,
It's like an office or a subsidiary.
it's like this.
Yeah.
If you don't have a subsidiary in India, if you don't have an office in India, it is just that you operate there. It's just that you operate in your country, right? Right now, it would not trigger any PE here. However, when you operate in your country, it may constitute significant economic presence in terms of explanation 2A, but it will not matter much to you because it is not there in the treaty. Though SCP is triggered and the business connection triggers, you can always fall back on the treaty to say that I don't have a PE. There is no concept of SCP in the treaty. I will fall back on treaty to say that I am not liable to pay tax. It's only when you don't, when you have a no treaty situation. See, many a times, see, we have about out of 210 jurisdictions, we have DTAA only with about 94 jurisdictions. The rest of the countries, we don't have DTAAs. So there, all these will matter, SCP will matter. And even with 94 countries, in many situations, DTAA may not be applied in your case because of GAR. Then, though there is a DTAA, you may not get the benefit of DTAA. Then also, significant economic presence could trouble you. So therefore, it's very important for you to be aware of that. Yes, any more questions? I could see some more questions popping. Yeah.
Is there any compendium consisting different models of PE and BC, business connection, for reference and understanding? Just a suggestion.
Somebody has to prepare it. Yeah.
Okay, that's all. I think you can go ahead.
One more, sir. Just having
Yeah.
a subsidiary in India constitute a PE in India?
Oh, it's a wonderful question. It's a very good question. See, mere subsidiary in India will not trigger a PE for you. However, in a given case, subsidiary may trigger a PE for you where subsidiary stands aside, in the sense the holding company's employees could walk into the place of subsidiary as if it is their own office. Their presence here is so all pervasive that the relation doesn't just remain as a shareholder. After all, what is the holding company's relationship with the subsidiary? It is a shareholder. But where its people keep coming here, keep sitting here, keep spending time in such a manner where it looks as though the subsidiary here is a virtual projection of holding company, then they would say the holding company has a right of disposal in respect of premises of the subsidiary, and hence the entire subsidiary will collapse into the holding company and will be treated as a permanent establishment. But mere status of subsidiary would not cause a PE. What causes PE is the principles which will govern when there is a fixed place of business. Same principles would decide. Yes, sir. There is another question?
No, sir.
Yeah. No, Mr. Shetty is reading something. Is there another question?
Yeah. Address given for US entity for PAN can create PE.
No.
One more similar one, having GST registration as non-resident will trigger PE.
See, it's like this. See, mere registrations don't trigger PEs. As you've seen, in order that there is a PE, it has to be a place of business where the business of the enterprise is wholly or partly carried on. So mere having PAN address would not mean you have a right of disposal tax there. You don't have a right of access. It is just that an address is given. That would not trigger PE. A GST registration would only allow you to do business. You have not done business as yet. A mere registration would not mean business is carried on. In order that a PE triggers, the business has to be carried on. Mere registration would not trigger a PE.
I think that's all.
That's it. So I'll just take about 5 minutes. See, in Formula One, very interesting case study which the delegates should spend some time to go through this, story. Of course, now, like it's long since Formula One was ever, done in India. It's quite some time before. See, look at this chart. You have FIA, which had the commercial rights to conduct a Formula One race, which were given to its company called FOAM, which in turn is given to a UK company called FOWC. FOWC is in charge of conducting Formula One races. There is one Indian company called JP International, which built a Budh International Circuit in the outskirts of Delhi, meant for racing. So they entered into an agreement whereby one race promotion contract was entered into between FOWC and JP for $40 million. One artwork license was entered into, agreement was entered into for $1. And back-to-back agreements were entered into by JP with 3 more companies: BP2, All Sports, and FOM. Look at this. JP agreed to give BP2 media right for $1 million, which is all these 3 companies, BP2, All Sports, and FOM, are part of Formula Group. Now look at what has happened here. I think, Mr. Shetty, there is some disturbance to the art. Somebody must have unmuted. Yeah. Is it fine now? Yes. See, what they made it look like is FOWC gave away all the rights to JP is how ostensibly it's made to look like. But back to back, these rights were, transferred back to the concerns like BP2, All Sports, and FOM, who are part of FOWC group. And by virtue of this arrangement, people of FOWC were allowed to come to specific areas in the both international circuit. They can get their people. They had ticketing rights. So they had so many rights. So eventually, it was their agreement, understood, it was their argument that they did not have a P in India because it is JP which did everything. Matter went to Authority for Advanced Ruling. Later on, it went to the Delhi High Court. Later on, it went to the famous, Formula 1 decision in Supreme Court, 394 ITR 80, where Supreme Court stated, they agreed with the Delhi High Court. They have said that all this is a camouflage. So though you had given the whole of the contract to JP, you took away most of the rights back from JP to your associate concerns, and you had virtual control on the entire area there. Although it is just for a few days during which the race is conducted, it is good enough to call it as permanent establishment. And they have said that FOWC has a right of disposal in respect of JP's premises for those 14 days during which the race was conducted, and hence FOWC is said to have a permanent establishment in India. It's a very interesting story. So it would take a lot of time to explain this. But then this is one case which has brought in GAR, which has brought in MLI without those still being in place. So when this case was decided, GAR was not in place. When this case was decided, MLI was not in place. All that fragmentation exercise, commissioner arrangement, which are discussed, playing the principal role, leading to conclusion of contract in Article 12 of MLI, the fragmentation which we have discussed in Article 13.4 of MLI were all applied by Supreme Court here. So very good decision from the point of view of understanding permanent establishment. So a lot many other topics which within this given point of time we may not be able to discuss this. So whatever is possible in this limited time, I have tried to convey to you. And I hope the delegates have got a hint of what is, awaiting them in the practice in future in terms of the developments that are taking place in the international tax area. And I would, sincerely hope that they would gear themselves up to be in a position to face the professional challenges arising in this segment. I would again thank Bangalore branch for giving this opportunity. Thank you, one and all.
Thank you so much, sir. On behalf of Bangalore branch, I propose formal vote of thanks for first session of today's program. Thank you so much, Chythanya, sir, for spending your valuable time and giving an excellent presentation. On behalf of entire participants and also on behalf of entire managing committee, I wholeheartedly thank you, sir. Thank you so much for such a grateful session, sir.
Thank you.
Thank you
so much, sir.
Thank you very much.
Thank you. So I can take leave now.
So
Yes, sir.
Yeah.
Let's take a 10 minutes break. Participants, next speaker will join at 5:55. Please come back at 5:55.
yes, sir. Yes, thank you.
Thank you. Hello, Suraj. Manish. Hello.
Yes, sir.
Just check Dhinal Shah.
Yes, yes, Alphonse.
Welcome back, friends. Before starting the next technical session, I'll take a minute or two of yours just to inform about Bangalore branch upcoming program. This 21st Monday, coming Monday, International Yoga Day, your branch is hosting a program on International Yoga Day, early morning 7:30 to 9. An expert on yoga, Dr. Naveen K. Vishweshwaraya is joining us, and he is imparting the benefits of yoga and various other aspects of yoga to all of us in first 45 minutes. And balance 45 minutes, there will be yoga practical session also. I request all of you to join along with your family members on coming Monday, 21st June, early morning 7:30 to 9. Friends, please register for that program. And 27th of June, this month 27th is International MSME Day. 27th of June, Sunday, is International MSME Day. Your branch is hosting a program along with Pinya Industries Association. It is evening 3 p.m. to 5:15 p.m. 3 to 5:15 in the evening on Sunday, 27th June. To inaugurate that program, Minister of Large and Medium Scale Industries, Government of Karnataka, Mr. Jagadish Shettar is joining to inaugurate that International MSME Day on Sunday, 27th June. I request all the members of Bangalore branch to join that program, and even the industry members also joining on that day. So it is a good program for the benefits of all the members, because on that day one of the speaker is going to inform all the industry members what all the value added services they can expect from a chartered accountant. Currently, chartered accountants are maybe providing compliance services like taxation, accounting, and auditing. Beyond that, many other services we can provide. In that aspect, a chartered accountant is going to inform all the industry members. At the same time, if our members also participate in that program, you can also understand, you can also equip with yourself, or you can network with persons who can provide those kind of services to your clients. This will be helpful, or in the area of new areas of practice, we can go or look around that. So the current traditional practice like taxation, auditing, and other services currently what we are providing may come down in the future due to automation and government initiatives, or ease of doing initiatives of government. So in that aspect, all of us need to look for newer areas of practice where we can help the industry members to grow, and simultaneously we can also grow in that process. In that direction, your branch is conducting that program. I request all the members to register that program. Registration is free. It is already open in the website. Please look into that and register for that program. And 1st July. 1st July is our day. CA Day is on 1st July. So CA Day is your branch is celebrating from early morning 9:30 to evening 7 p.m. Morning there will be a flag hosting, and chief guest is our past president CA R Balakrishnan is going to be our chief guest on CA Day in the early morning. Then subsequently in the afternoon 4 to 7 there are two sessions. One is a panel discussion and another one is a session from Dr. Guru Raj Karajagi. So please look into Bangalore ICI.org website and register to that program too. So panel discussion is a very interesting topic. CA profession by 2030 in the changing scenario. So I request all of you register, and also tell your article students also register for that program. It is CA profession by 2030. The panelists are CA Mohandas Pai, CA Nilesh Vikamse, our past president, Padmini Srinivasan, Professor IAMB, she is also CA Chartered Accountant, our Central Council member Dayanima Sharma. The panel discussion is moderated by CA Gururaj Acharya. So I request all of you to register that program. With that note, once again, welcome back. Our next technical session speaker, CA Dhinal Shah from Ahmedabad joined. Hello, Dhinal sir. Hello.
Yeah, good evening, sir.
Good evening, hearty welcome. Friends, CA
thank you.
Dhinal Shah from Ahmedabad joined us. So even in his busy schedule, he has given us time. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Dhinal Shah.
Thank you, sir.
Hearty welcome, sir. Please switch on your video, sir.
Yeah, I just started. 1 second. I have started. There is some background.
Yeah, some low bandwidth is there.
Anyhow,
let us go with that. Divya, please introduce the speaker.
Yeah.
Introduce him. Very good evening and welcome back all the participants or all the dignitaries in the panel. To give a brief introduction about our next technical session speaker, we have CA Dhinal Shah with us. He is partner of EY's Indian member firm. He is a chartered accountant and lawyer by qualification and has more than 25 years of experience in advising clients on taxation, exchange control, and regulatory issues. He is also executive committee member of International Fiscal Association and secretary of ITAT Bar Association, Ahmedabad. He was Central Council member of ICAI and director of IP and RVO formed by ICA and was also chairman of Direct Tax Committee of Gujarat Chamber of Commerce and Industries. With this very brief introduction, I welcome you for today's program on behalf of entire managing committee members. Hearty welcome to you once
Thank
again.
you. Yes. Thank you, Divya.
Over to you, sir.
Thank you. Yeah, thank you. And good evening to all of you. And thank you very much to all of you and the Bangalore branch for giving me this opportunity to share some thoughts on attribution of profits to the business connection or a permanent establishment. I understand that prior to this session, my good friend Chythanya took on what is permanent establishment.
Yes, sir.
Yeah, and I will just touch upon broadly, just to keep the context in place from attribution of business profits, that generally the principles of fixed place business under Article 5 of a tax treaty, either an OECD convention or the UN convention, is broadly understood as what is called a disposition test, and through which a business is carried on. Then there are certain the construction or a supervisory PE or a service permanent establishment or a dependent permanent establishment. These are in additional categories of creating a permanent establishment. If you go back to the business connection definition, and which has been substantially increased the scope by introducing the significant economic presence of SEP concept from 1st April 21. I understand that Chythanya would have already taken, but I will, in the course of presentation, I will slightly touch upon only from the perspective of the pre-attribution perspective. And then on the transfer pricing law, section 92 capital F provides what is permanent establishment as a fixed place of business through which the business of the enterprise is wholly or partly carried on. Now, let me go back to first the domestic law. There is only one rule, Rule 10, which defines for the attribution of profits as far as permanent establishment is concerned. It says if the actual profit determination fails in the opinion of the assessing officer, the assessing officer can ascertain the profit either by adopting a reasonable percentage of a turnover or by adopting a global profit formulatory approach in the ratio of Indian receipts to total receipts, or in such other manner as the officer deems suitable. So when we look at certain judicial development on this in India, we will look at that the tribunals and high courts have followed different approaches by adopting either one of them for the purpose of attribution of income when there is a business connection or a permanent establishment under Article 5 read with Article 7. Under Section 911, the law says that the attribution should be restricted, which is reasonably attributable to operations in India. Now, the word attribute and word derived from, we have learned in our tax practice. The Supreme Court has clarified way back under Section 80I that word derived is a very narrow meaning, but word attribute is a much larger terminology and broader in scope compared to the word derived. And therefore, Section 911 provides about the attribution of profit which is reasonably attributable to operations in India. And we will have to understand and deliberate about what is reasonably attributable. The circular number 23 of 23rd July, though that is today, that circular has been withdrawn by the board, but it did say that Section 9 does not seek to bring the tax net profit of a non-resident which cannot reasonably attributable to the operations carried out in India. It is only that portion of the income or the profit which can reasonably be attributable to the profits or the operations carried out in India. And then we had a circular number 5 of 28 September 2004 in para 2. The focus was on attribution as per treaty. Now, as you and me all are aware that India's treaties are either based on OECD convention or UN convention. Largely it is based on UN convention being a developing nation. And therefore the focus is on attribution as per treaty and confirms and reiterates that the non-resident profit is taxable only in respect of the profits attributable to operations carried out in India. And then it also says that it should be based on arm's length principle. We have certain presumptive taxation, like in case of the shipping industry, in case of the power sector, in case of certain other sectors where the government deems certain income which is treated as a deemed attribution of income in India. And then we have Section 44 capital C, which provides for the allocation of an administrative overheads or certain head office expenditure in case of the determination of the profitability of the permanent establishment. Let me go back slightly to the history. The OECD model from 1963 to 2008 was based on the FAR analysis introduced under Article 7.2. And what is FAR, we all know when we practice on the transfer pricing. Then in 2008 to 2010, the incremental argument was that the receipt, expense, and working capital recognized for apportioning the profit to the P, which is included in Article 7.4. Because when you carry on the business in India or in a particular contracting state, there would be funding and there could be an interest expenses which is required to be considered for the purpose of determining the appropriate income which is taxable in a particular contracting stage. Since 2010, the broader approach of the OECD commentaries of FAR, which was there in 1963 to 2008, as per Article 7.2. And then it was the commentary on Article 7.4 on receipt, expense, and working capital, which is now included as a steps in Article 7.2, and therefore that references have been removed from Article 7.4. Under UN model, the position was broadly the same, similar to OECD prior to 2010, but UN model also includes what is called force of attraction rules. What is force of attraction rule? We'll look at slightly later. But the OECD has specifically not accepted the force of attraction rule because the OECD commentary believes, based on the contracting states tax treaties, that if you add the force of attraction rule, then there are chances that the income which is allocated based on the taxing rights between the contracting states may not be uniform and may not reflect the true income which is taxable in a particular state. And that also creates an administrative hurdles while giving a tax credit in the other states. And therefore, the OECD has specifically rejected the force of attraction rules to be included in the commentary under Article 7.2. Indian treaties, as I said, is mostly based on the UN treaties prior to 2010 model of the OECD, which is more or less similar between the UN and the OECD model. The 1963 draft convention, which the first convention which was issued by the OECD, which mainly said that if the separate accounts are maintained, that must be taken into account. And they also clarified that when the accounts need to be rectified, particularly when there is a transfer of goods between the state resident state and the state, in that case, if the prices are transferred is not on arm's length, or if one country considers a particular price at an arm's length and the other country considers another price at an arm's length, then that needs to be aligned, and that has been specifically stated in Article 7.3, including the commentary of the OECD. In 2008 Model Tax Conventions, the OECD recognized and acknowledged that the sales expenses and working capital could be one of the criteria for the purpose of apportionment of the profits to the permanent establishment. And it also says that even if the P is to be taxed on the profits, it would be expected to make it a distinct and separate entity. Now, this is very, very important for the purpose of attributable of the income to the operations carried out in India, that the P is treated as a distinct and separate entity. The moment you treat a P as a separate and distinct entity, it will create number of issues, but it will also resolve number of issues, particularly for the allocation of the taxing rights between the two countries. And then post 2008 commentary, including the latest commentary of 2017, the OECD says that the arm's length principle is applicable, and therefore the FAR analysis for the distinct and separate entity should be followed for the purpose of attribution of income to the permanent establishment. What is a broad framework for the purpose of Article 7? The purpose is to allocate the taxing rights between the two contracting states and are not subject to different rules under the articles. Now, this is a principle which normally two contracting states will agree on any source of income. If it is a royalty, or if it is a fee for technical service, or if it is a dividend, it is a negotiated allocation of taxing rights depending upon the character of the income. The existence of the permanent establishment is precondition for the purpose of attribution of income for application of Article 7 and then application of Article 9 as the arm's length principle under Article 9. And therefore, if there is no PE, then you will have to apply the other articles of the tax treaty, which could be independent personal service, which could be the royalties or fees for technical services or any other income, but it would not apply Article 7 of the attribution of income unless there is a permanent establishment. The underlying principle is the separate and distinct entity and on an arm's length principle. So these are the broad framework as far as Article 7 is concerned from the attribution of income to a permanent establishment. Now, what are the OECD approaches which have been followed till now? One is the ad hoc attribution of approach. So based on the extent of operations carried out by India, and then you apply ad hoc percentage. For example, in a judicial development in Rolls-Royce case, where there was an accepted permanent establishment based on the survey conducted by the tax department, the assessing officer and the tribunal estimated an ad hoc percentage of turnover based on certain broader principles, and which was also confirmed by Delhi High Court. So it was more of the ad hoc approach, which was followed by the tax officer, and subsequently it was confirmed by the tribunal and the High Court, though the percentage was reduced by the High Court, and we will look at that particular issue later on. The other is a formulatory approach. The formulatory approach is basically that you take the global profits into consideration, and then you allocate a global profits into the profits which is attributable to the permanent establishment in a particular contracting state. But in that case, suppose if there are losses in a console profit or a global profits, then would it mean that the permanent establishment which is situated in a particular contracting state also would have incurred a losses? Because Article 7.1 and Article 7.2 does clarify that when you take distinct and separate entity approach, it may so happen that globally there are losses, but there are profits which are attributable to the P in India, or vice versa. You may have global profits in the foreign country, but you could have losses as far as permanent establishment is concerned. And therefore, when you follow the formulatory apportionment, it may not work from a scientific approach of a distinct and separate entity approach, which has been now followed consistently and for the purpose of attributing the profits to a permanent establishment. The FAR approach, which we are doing right now under the transfer pricing, is one of the suggestions of the OECD. And then you have the functional and factual analysis, the attribution of assets, and the attribution of risk. And based on these FAR analysis and based on the methodology followed in the transfer pricing, these principles are normally followed. The OECD report also considers two approaches. One is the relevant business activity approach and the functional separate entity approach. The relevant business activity approach, which I just discussed a few seconds back, is a formulatory apportionment approach, whereas the functional separate entity approach is a separate and independent enterprise approach. And therefore, the functional and separate independent approach would be our preferred approach as far as the OECD recommendation is concerned under the Article 7.1 and Article 7.2. And all OECD countries treat the permanent establishment as a separate enterprise, but the attribution of profits can differ from one country to another country depending upon the local principles. For example, in India, as I said, we have certain deeming fiction to attribute profit for certain sector of industry. Plus, we have Section 44 capital C, for which limits the allocation of the head office expenditure while concluding the profits of the permanent establishment. Interestingly, India has filed its reservation with the OECD as far as this particular approach is concerned based on the FAR analysis. And the reason which I believe, which we will look at slightly later, one of the example, is that whenever you take a distinct and separate entity approach, since India is a net importer of the capital and the technology, India may lose certain taxation, particularly in the technology of royalties and fees for technical services, which is used for the purpose of or which is attributed to the operations of the permanent establishment. And we'll take a slightly later a similar example that why India should have a reservation as far as this particular distinct and separate entity approach is concerned. The OECD approach has the following steps which are required to be followed. So to determine the profits, you first do the functional and factual analysis to determine the activities and conditions of the P. So the step one, you hypothesize the P as a distinct and separate entity based on significant people function. With your permission, I will just read few lines from the OECD commentary on para 21. It says, for the purpose of functional and factual analysis, you should attribute to the permanent establishment as appropriate of the rights and obligation arising out of transactions between the enterprise of which permanent establishment is a part and separate enterprise. In identification of a significant people function, to the attribution of economic ownership of the assets and the attribution of economic ownership of the assets to the permanent establishment. So in the slide before you, you have functions performed, you have assets used, the risk assumed, the capital and the funding, and the recognition of the dealing. Now this is one of the important part for our deliberation about recognition of dealing. And then in step 2, you determine the profits of the permanent establishment based on comparability analysis and based on applying the transfer pricing methodology to attribute the profits to the permanent establishment. The para 21 of the OECD commentary, it also says the identification of significant people function relevant to the assumption of risk and attribution of risk to that permanent establishment. The recognition, now this is most important, the recognition and determination of the nature of those dealings between permanent establishment and other parts of the same enterprise that can appropriately recognize and having passed the threshold of the test referred to in subsequent paras, and the attribution of capital based on assets and risk attributable to the permanent establishment. So these are the steps which one will need to follow, and what is that capital and funding and recognition of dealings we'll slightly look at later on. What is the first step? The first step is a functional and factual analysis. Identify the activities and responsibilities of the enterprise that are associated with the permanent establishment. So your functions performed by the P in the jurisdiction on its own account, or the functions performed by the P on behalf of the other parts of the enterprise. And the third, functions performed by other parts of the enterprise on behalf of the permanent establishment. And then you have the fixed place, which is a principle for creating a permanent establishment. And then what is the functions performed by that fixed place through which the business is carried on. And in case of a dependent agent, examine the functions performed by the dependent agent on behalf of the enterprise. Step 2. What is the attribution of assets? The legal ownership cannot determine the assets owned by the permanent establishment. There is an economic ownership which is introduced as far as the attribution of assets to permanent establishment is concerned. And let me give you an example. I am a foreign entity. I own substantial technology. I own substantial brand, which is being used by my permanent establishment in India. Now the question is that can I allocate a proportionate royalty which I would have paid if I would have taken this from a third party under uncomparable uncontrolled transactions. If under a comparable uncontrolled transactions, if I would have paid royalty for use of technology, use of know-how, use of drawings, or use of brand, then there is an attribution of the economic ownership which is attributable to the assets of the P, even if there is no legal attribution of the assets. The attribution of economic ownership depending on type of business and type of assets. For a tangible assets, it is all about the economic ownership, the example which I just took. And then what is the management of the risk related to the intangibles. So whenever you attribute the economic ownership or the economic value for the purpose of determining the profits of the enterprise, then you also ascertain what is the risk profile in relation to or which are attached to that particular intangibles. Attribution of a risk. Between the associated enterprises, the risks are assigned based on contracts. Normally, we have understood, particularly after the BEPS section plan 8, 9, 10, that the risks are allocated based on the functions performed. But as far as the associated enterprise, which country will bear a particular risk between the two contracting states? Between the head office and the P, enterprise as a whole bears the risk, but you will have to allocate based on the FAR analysis of allocation of risk between the head office and the permanent establishment. However, under the revised OECD approach, which is called authorized approach, the risk may be assigned to P despite absence of a contractual arrangement. And therefore, even if there is no contractual arrangement, but if there are risks which are taken by the permanent establishment in carrying on that business activity, then you assign and attribute the value for the while determining the profitability of the permanent establishment. And just to take an example, that even if there are negligence of the employee performing the functions of the permanent establishment, now that risk also could be assigned for the purpose of computing the profitability of the permanent establishment. The next is attribution of free capital and funding. Now, the permanent establishment, which is an enterprise in a particular contracting state, will require capital to do day-to-day business. He could have borrowed money locally, subject to FEMA compliances, or the head office would have granted a capital or a working capital or a fixed capital for the purpose of carrying on the business. Now, the interest expense is deductible for tax purpose, and therefore it is necessary to ensure the appropriate attribution to the enterprise free capital to determine the arm's length attribution of the P. For example, today it has been accepted fact, and particularly the special bench judgment of the Sumitomo Corporation, that the interest expenses is deductible while computing the profitability of the permanent establishment. The only thing that one will have to demonstrate by a FAR analysis that the permanent establishment was in requirement of a funds and the head office, either on its own or through the any other unrelated or related party, has funded the permanent establishment for which the interest is being paid. Now, whether the interest itself would become taxable under Article 10 or not, we will slightly look at later on. There has to be a direct relationship between the risk and the capital, and therefore it also provides a cushion against crystallization of the risk into actual losses. The OECD report merely provides a guidance on the principles of capital attribution, the exact approach to be determined based on the facts and circumstances, because it will depend upon how much capital have I borrowed, from whom I have borrowed, what is the security, what is the guarantee, what is the notional interest rate. These are all questions this one will have to ask when you apply these attribution of free capital and the funding while carrying out the dealings between the head office and the permanent establishment. In a fully hypothesizing P as a separate entity, it is necessary to identify, determine the nature of internal dealings. Now, these internal dealings would include providing of a services by head office, providing of the know-how by head office, providing of the support of the manpower, direct or indirect, providing of any other intangible assets or tangible assets which are required for the purpose of carrying out the business of the permanent establishment in India. Now, examples of the D, as I said, I use services, assets, and services. Now, let me take a classic example on these dealings. Right now, I'm actually dealing with one of the case where a France company had participated in a tender with one of the government housing project. The France company got the award from an housing project in India, and as per the tender condition, the foreign company was required to set up a project office under FEMA for 5 years. And the role of the France bidder is divided into two parts. One is to provide designs and drawings for that entire affordable housing project, and then to coordinate with the local architect, local contractors, local project management, local entity for the purpose of to see to it that the affordable housing project is constructed in a 5 years period, and then overall monitoring and management of that construction building. And if there are any issues between the designs provided by the France country or by the local architect and the engineers. Now the question is that the France company has set up a project office. After the France company has set up a project office, the designs and drawings will be provided by the France office. Now, there are two issues. One is a tax issue from determination of a permanent establishment income. And the second, incidental, is also about the GST liability. These affordable housing services are being provided to a government entity, and therefore there is no GST as far as services being provided by the project office to the government. But what happens to the designs and other drawings and designs which are being provided by the France entity to a project office from a GST perspective? Now, it could be treated as an import of services, or if it is only an allocation of an expenditure, and where the performance of the service is outside India, one could argue that GST is not applicable, but one would have to examine depending upon the facts of the case. The second is that when the France PET entity is providing drawings and design to a project office in turn will supply to the customer in India, which is a government entity. The question is that whether the cost of these designs and drawings is required to be determined based on arm's length principle, that what is the profitability of a permanent establishment. And the second question is, when the permanent establishment makes payment towards drawings and designs, whether it would fall into FTS or a royalty. Now, the special bench of Sumitomo took a view that as far as interest expenses are concerned, when you calculate the profitability of a permanent establishment, you attribute the interest expenditure for the purpose of determining the taxable profit of a PE. But when you make payment of interest, you are making a payment to a self, and therefore you can't have income chargeable to tax under the Income Tax Act when you make payment to a self. And therefore, taking the same principles here, that when the project office makes payment for drawings and designs to the foreign entity, then that income is not taxable in India, and therefore there would not be any requirement to do any withholding tax as far as the payment towards the drawings and designs are concerned. And the third is that whether a foreign entity itself would be taxable in India for providing drawings and design in India under Article 12 or under Section 916 or 917. Again, the answer is no, that it is providing a services to self, and therefore again that income is already been considered for the purpose of attributing the profit to the permanent establishment, and therefore the foreign company again will not be subject to taxation on providing these drawings and design to a project office in India. And this is one of the concern of India, because if these royalties and fees for technical services would have been chargeable to taxes in India, there would be a requirement of withholding of tax of minimum 10% under domestic tax. In this case, India is neither getting 10%, and the drawings and designs are actually being deducted while calculating the profitability of a permanent establishment. So from an India perspective, I have shown this reservation about separate and distinct identity of the permanent establishment for following the FAR approach as far as the calculating the profitability of a permanent establishment. When we look at SEP also requires that the government will come out with the rules for the purpose of attributing the profitability to India. As of now, the notification on 3rd May has been issued prescribing the limits of applicability of SEP, but the rules for attribution of profits have not been notified by the government, and therefore today, in the absence of that, the only fallback mechanism would be Rule 10, which we just looked at a few minutes back. So this is one important part on the recognition of the other dealings. Similarly, the section 44 capital C provides for allocation of maximum up to 5% of the expenditure. Now it is an established law, including by the high courts, that this 44C is only applicable for the common expenditure, which is not directly relevant to the services being provided to permanent establishment. You would have CEO, you would have CFOs, you will have separate premises, you would have paid certain rent for those premises, overseas office, and you allocate indirect expenditure, which is called general administrative overheads. But as far as direct expenditure is concerned, it does not fall into section 44C. And if the direct expenditure is on arm's length basis, then that expenditure is eligible for it to be deducted for the purpose of computing the profitability of the permanent establishment. But as far as the general administrative overheads are concerned, section 44C limits up to 5% of the adjusted total income, which is defined in section 44C. The general administrative overheads is also, the nature of expenditure is also given in section 44C, and therefore I am not repeating, but subject to that principles, the direct expenditure is not covered under 44C. Determining the profits of the P and the documentation. Now, step 2 is about the FAR analysis and the what we call under the transfer pricing methodology is the benchmark exercise, depending upon the method described under the TP guidelines. So from India perspective, we will have to follow the most appropriate method principle given in section 92 capital C based on the FAR analysis as far as the attribution of profits are concerned to permanent establishment. Now, there is no specific requirement either under Article 7 or under section 911 to maintain a specific documentation. But I would believe, and which is also being clarified in Article 7.3, that since it is a separate and distinct entity approach, you should follow a similar documents which normally you would have followed if there was a different legal entity rather than a permanent establishment. And therefore, what normal documents you would have followed for a separate distinct entity approach, you should also follow the same documentation for the purpose of this, including for the existent characterization in terms of dealings that also should be considered as far as documents are concerned. This is one example which today, based on the decisions of the Supreme Court, decisions of the Bombay High Court, in Morgan Stanley Supreme Court, the SET satellite in Bombay High Court, and then subsequent judgments. This principle is not relevant for us today, but I wanted to highlight one point which is called the OECD authorized approach, where you have the dependent permanent establishment. The question was that will only single entity will be taxed in India, or will there be a dual entity which would get taxed in India? And let me take a simple example. So you have a foreign company which is engaged in the business of manufacture and sale of electronic goods. It has a liaison or subsidiary office for sales and support marketing services. The liaison or subsidiary company identifies the prospective customers, understand the requirement, and participate in negotiations. The customer places purchase order directly on the foreign company, and the foreign company arranges for delivery of goods to the customer locations in India. And therefore, based on this principle, it is evident that the foreign company has a permanent establishment in India. Now, this is a dual entity approach. So what happens into dual entity approach? That the product ordering and negotiation is being done by the permanent establishment of a foreign company and not by an Indian company. Similarly, the marketing and a sales force, it is based on the functions and not the employment agreement. And therefore, that is one to be considered. And therefore, that sales function is also being considered by the permanent establishment in India. Then you have a marketing and advertising strategy, which is performed by both Indian entity and by the permanent establishment. After sales support is also being given by both the entities. The inventory risk is kept by the permanent establishment. The inventory risk itself and the both inventory storage is kept by the permanent establishment, and the foreign exchange risk is also kept by the the permanent establishment of a foreign company. So this is a dual entity approach, which has now not been accepted in the 2017 commentary, because it was creating a dual entity approach is not accepted. Even India has not accepted based on the judicial principles. If you recollect, the Bombay Tribunal in set satellite judgment did follow this based on the draft authorized approach of the OECD, but which was rejected and dismissed by the Bombay High Court when the matter traveled up to Bombay High Court in a case of set satellite. So this dual entity approach today in India is not followed, but only a single entity approach, that is the permanent establishment of a foreign entity, whether it is a fixed place, whether it is a dependent agent relationship, whether it is a service permanent establishment or any other permanent establishment. If it is being remunerated on arm's length, then no further attribution is required as far as the P is concerned. From the introduction of the BEPS, and particularly BEPS Section Plan 7, the substantial changes has been made in 2018 commentary of the OECD. It sets out the general principle for attribution of profit in the light of changes in Article 5 of the OECD Model Convention. It includes the examples for attribution of profit similar to warehousing activities, the commissionerate arrangement, or online advertising structure or a procurement, which examples we will also look at subsequently in the subsequent slides. It also applies to whether the tax administration should adopt an authorized approach or other approach used to attribute the profitability. It also discusses about the interrelationship between Article 9 and Article 7 to avoid a double taxation in the source country. Because this is very, very relevant, particularly when there are transfer of goods or services between the head office and the permanent establishment. And if both the countries follow different arm's length principle, then there are all chances of the double taxation, which is also being explained in Article 7.3 commentary. Clarifies that while some functions may be considered of both significant people function and the risk control function, any conclusion cannot be drawn against alignment of the true principle. Now, significant people function is again the same principles under BEPS Section Plan 8, 9, 10 is a value creation. So where is the people and where is the value creation? That would be very, very relevant for the purpose of attributing the profitability to permanent establishment. No duplicate attribution should be made based upon single function, considering the same as a significant people function or risk control function. And then it says that does not intend to extend application to countries that have not adopted the approaches in the tax treaty or the domestic legislation. Now, as far as India is concerned, India has not adopted this in the domestic legislation. The Indian law under Section 911 simply refers to the income reasonably attributable to the operations carried out in India. And then Rule 10 does not define any substantial methodology about what is attribution to profit, but it gives 1, 2, and 3 alternatives while applying Rule 10 for the purpose of attributing the profits. So let me take the first example. These examples are a part of the OECD report itself, and therefore, but to explain this principle, let me take this example. Our trade company, a resident of country I, R, which buys and sells widgets, which is a sale company, a resident in the country S. S is basically a source state. It performs the marketing and service activities on behalf of trade company in country S, which is a source state. Trade company and S company are the associated enterprises, and therefore it consists only of the activities of the trade company. Sale company does not own the inventory at any point of time, but sale company does not have even the entitlement to the amounts paid by the buyers for the widgets, and these amounts are being paid directly to the trade company. The personnel of the sale company are responsible for warehousing the inventory and determining and monitoring the appropriate inventory levels. The trade company remunerates the sale company by way of a commission equivalent to a percentage of sales revenue received by the trade company from the sales made to the sale company on behalf of the trade company. And what the approach is? The functional analysis shows that the trade company personnel located in company R country R deal with the purchasing of widgets from a third party. So let me skip this explanation and let me go straight. When you compute the commission structure, when you have a permanent establishment in India on a commissioner structure, so what it says that revenue from the sale of widgets to the customers in country S. So though the relationship between R country and S country, the R country sells goods directly to the customers in India. But for the purpose of computing the arm's length commission, which S would have earned, the S would show that it is a sales by S to the ultimate customers in India. So for the purpose of preparing the profit and loss account for attributing the profitability to country S will say that I have actually purchased the goods from country R and I have actually sold to the customers in India. And then you have the comparable uncontrolled price as far as sold to a third party. But when you are notionally contributing the purchases from country S, you would normally say that if country S entity would have purchased a similar good from a third party, what would be a purchase price? So then less amount paid by the P for inventory purchase from a trade company. Other expenses, what is the arm's length remuneration? That should be the profit attribution as far as working is concerned. Now, this is very, very relevant because in item number 2, the amount paid by P for the inventory purchase from trade company, actually there is no payment because the payment is the goods are sold by the trade company directly to the customer. But this is more for the purpose of comparability of the profit attribution on an arm's length principle. And therefore, what happens? Suppose if the country S takes that arm's length price of these goods is 90 rupees, whereas the trade company takes these either as 110 or at 70, then there could be a potential double taxation on these 20 rupees. Now, when you give a credit under Article 23A and Article 23B, either under exemption or a credit methodology, the country R, which is a resident state, would have to consider that what is the appropriate allocation of taxing rights to the country S, and then based on that, the tax credit would be given by the country of residence. And therefore, determination of an arm's length price, which is mutually acceptable to both the countries, would become very, very relevant factor when you calculate the line item number 2 for the purpose of computing the profit attribution under commissioner arrangement. Sale of an advertising. Now, here also, the principles are same, that revenue from the sale of widgets to customer in country S, what amount country S would have paid for the rights of the advertisement space from a site company, and then the other expenses, and then the arm's length attribution of the profitability. Now, in a digital world, it is very, very difficult to ascertain the comparable cost for the purpose of rights for the advertisement space, and therefore it would become more critical and more scientific approach one will need to follow as far as sale of advertising space is concerned, and to find out a comparable price for calculating the profitability of this. And this also presupposes that it is a single entity approach, that once a permanent establishment is remunerated on arm's length basis based on this principle, then nothing further is required to be attributed to the dependent agent permanent establishment, which is DAPE. Here it is a procurement of the goods. So here it is basically the country S, which is a source state, is providing a performance or a procurement activities. And there the question is that how do you calculate the profitability of the states of the source state for the purpose of procurement activities which is being performed by the company. So it says that the amount that the trade company would have to pay if it has purchased widget from unrelated enterprise performing the same function in a country's or the source state that by the performs on behalf of the trade company. So if country R would have paid an X amount to an unrelated party, that would be the amount. From there, you would actually reduce the amount paid by trade company to unrelated suppliers. Then you adjust for the expenses and the margins, and then you actually calculate what is the profit attributable to this permanent establishment, which is a DAPE for the purpose of Article 5 and read with Article 7. Now, this is one important comparison between the OECD and the UN approach. And as we looked at earlier, that prior to 2010, the OECD approach and the UN approach was more or less same. But post 2010, the OECD follows a FAR analysis for the purpose of profit attribution and alignment with the transfer pricing guidelines. And then the apportion method for the attribution of profit based on domestic tax laws is omitted from the post 2010 guidelines. Whereas under the US approach, it grants the taxing right to the source countries, accepted the apportionment based on receipts, expense, and working capital. Also based on the apportionment method based on the domestic law, which is our Rule 10. It also accepts limited force of attraction rule. What is limited force of attraction? We'll just after this particular slide, we will look at this, and ensures that the actual profits of the entity derived by PE from a source country subjected to tax without any notional adjustment of sunk costs, royalties, fees, commission, interest borne outside the source country. This is a major bone of contention for a developing economies, which is a net importer of technology and net importer of capital, because the notional adjustment for royalties, fees, commission, or interest expenses, there is a base erosion as far as developing countries are concerned, and that is why India has shown a reservation as far as this particular approach to the OECD is concerned. Mr. Shetty, do you want to take questions? Because I saw one or two questions.
Yeah.
So we will look at after 10:50. I was thinking to finish by 7:15, 7:10, 7:15, and then take questions for 15-20 minutes.
Yeah, that sounds good. We'll do like that.
Okay, fine. Let me skip this slide and let me go to. Let me first go here and then we will come back in the earlier slide. So what is force of attraction rules? Force of attraction rules is, it could be a full FOA or it could be a partial FOA. So there is a acceptance of a permanent establishment in the source state. And let us take an example that I have a branch in India, which is carrying on certain manufacturing activities in India and then selling goods to the customers in India. The foreign entity also sells directly the goods to certain selective customers in India. So the branch serves mainly the retail market, but wherever there is a wholesale trade, the wholesale trade transactions are normally carried out by the foreign entity, for which there is no role as far as permanent establishment is concerned. The second situation is that the foreign entity sells goods to the or same or similar goods to certain customers in India, for which the permanent establishment which is situated in India does provide support either for initial identification, negotiation, or for after sale support services. And there is an effective contribution as far as permanent establishment is concerned. But it is only for same or similar kinds of goods and not otherwise. Now, in the first situation, where there is no involvement of a permanent establishment, when the goods are sold by the foreign entity to the Indian customers, which is on a wholesale basis, the question is that whether India will have a right to tax even the profitability made from those transactions. Article 7.2 normally would use a language. We normally use a language. It is before you on the slide on bullet number 3. Directly or indirectly attributable to that PE. The question is, what is directly or indirectly attributable to that PE? The Supreme Court in Ishikawa rejected the argument of the department that under India-Japan Treaty, which is an OECD country, the OECD commentary has rejected the force of attraction rules. And therefore, the indirect attribution or to the permanent establishment does not refer to force of attraction rules. But in a Linklater's judgment of a Bombay tribunal, they followed the force of full attraction rules. So in other words, India has treaty with certain countries based on UN model, where either a limited FOA or a full FOA is applicable. As far as full FOA is concerned, as I said earlier, the OECD rejected because in our example, if the foreign country does business directly with the customers in India without any involvement of permanent establishment, the foreign country believes that India should not have any taxing rights on the income earned from that transaction because there is no economic nexus between a P and that particular activity. But if there is a nexus of activity between a P and that sales, then to the extent of limited force of attraction, and it says provided transactions are same or similar kind as that effected through the PE. So if I am in a manufacturing of, say for example, an engineering parts, and if those engineering parts are sold by the foreign entity where there is a involvement of a permanent establishment, directly or indirectly, to that an extent, under India-US treaty or India-Canada treaty, the limited force of attraction rule is applicable. But full force of attraction rule was applicable only between US and UK way back in 1945 treaty. And normally, the full force of attraction rules will actually create the dichotomy on allocation of taxing rights. And therefore, normally that principle is not followed. As far as US model is concerned, it does follow a limited force of attraction rule under Article 7.1, and that is why in the UN model, the example of India-US DTAA is actually following the US model of convention. As far as OECD is concerned, this particular clause is not applicable. Let me go back one slide. As I said, UK, Japan, Malta, Vietnam, Oman, Switzerland, Uzbekistan, Singapore does follow a limited force of attraction rules based on the UN model convention approach. The term directly and indirectly in some of the treaties has actually been clarified. So it says the word directly or indirectly mean for the purpose of this article, then when a P takes an active part in negotiating, concluding, or fulfilling the contracts entered into, not by the enterprise and notwithstanding the other parts, so and so. So in other words, in the limited force of attraction principle, if the P is involved into these activities, then only to that an extent it is indirectly attributable. But if the P is not at all involved, then the full force of attraction rules may not apply, which is also being clarified by the Supreme Court in Ishikawa. I will skip these slides and let me go to Ishikawa. And Supreme Court said on account of what is directly or indirectly on attributable to the P. And the Supreme Court, based on Article 7.1 and based on the protocol which was signed between India and Japan, and let me read this protocol, which is very important language. It understood that using the term directly or indirectly attributable to the P, profits arising from the transaction in which permanent establishment has been involved shall be regarded as attributable to permanent establishment to the extent appropriate to the part played by the permanent establishment in those transactions. It is also understood that a profit shall be regarded as attributable to the permanent establishment to the above extent, even when the contract or order relating to sale, provision of goods and service in question is made or placed directly with the overseas head office rather than with the permanent establishment. So in other words, unless there is a direct or indirect role played by the permanent establishment in that particular activity, there is no force of attraction rules. The last para, the Supreme Court noted that the P's non-involvement in the offshore transaction excludes his being part of the income. The Supreme Court referred to para 6 of the Protocol of India-Japan DTAA and then clarified that as far as offshore transactions are concerned, this is not covered under the FOA principles under India-Japan Treaty based on this protocol. The same principle was followed by the Bombay Tribunal in Roxon OI 291 ITR 8275. I am not repeating this. It is available in the presentation. But the same principle that the offshore supply is not applicable as far as the sale of equipment is concerned. The significant economic presence concept, which is applicable from 1st April 21, and where you have a revenue link condition of supply of goods or services in aggregate more than 2 crores, or a systematic and continuous soliciting of business activities or engaging in interaction with 3 lakhs or more number of users in India. And the conditions are mutually exclusive and irrespective of the place of business. And if you fulfill these 2 threshold criteria, then you will have a significant economic presence or a nexus theory, and it will ultimately create a business connection in India. I will skip this because Chythanya already would have taken this into account, and therefore I don't want to repeat this. My open questions also we can skip. Okay. Only one open question is about that the notification was issued on 3rd May 21. The law is effective from 1st May 21. And therefore, can somebody argue that for a period of 32 days, it was an impossibility of performance and so the law should not apply? My personal view, it is arguable, but you should argue only if you fall into this trap and you are into litigation. But otherwise, out of conservative approach, one should not litigate as far as this is, because impossibility of performance issue you will ultimately see the Supreme Court to decide whether the impossible performance was not. And the second is that pending the notification of the attribution rules, whether the existing Rule 10 should apply or not, I would believe that Rule 10 is a very, very generic and a general rule for the purpose of attribution of profits, and therefore one should fall back upon the Rule 10 for the pending the notification of the profit attribution rule under SCP principles. The CBDT constituted a committee for amendment to the PE attribution rules. And the background which was there, that the CBDT said that there has to be a mix and balance approach that allocates the profit between the jurisdictions with necessary safeguard to prevent excessive attribution on one hand and to protect the interest of the Indian revenue on the other. And then the committee suggested a 3-factor approach. One is the formulatory apportionment approach, which says it is very difficult, it may not be practically feasible to follow a formulatory apportionment approach because the data of several countries is difficult to compile. The lack of clarity as to CBCR data could be used, and CBCR is applicable only beyond a particular threshold of 750 million euro. The second approach, which is a fractional apportionment approach, was suggested by the CBDT. The CBDT said that you consider the profit from different countries is not required, and then apportion is based largely on India-related information, and therefore it is feasible to apply based on the operations carried out in India. Now, what are the distinction between the OECD approach and the fractional apportionment by the CBDT. The authorized approach considers a separate and independent enterprise based on fair analysis and based on transfer pricing principles of arm's length, including for the entering into dealing with the enterprise of which it is a part, which is basically intra-group dealings. Whereas the fractional apportionment by the CBDT approach, it emphasizes on the both supply and demand factors, rejects the FARS and authorized OECD approach by underlining India's position on the OECD Model Tax Convention and outlines the fractional apportionment approach. So there are 2 or 3 fundamental issues. One, whether a FAR analysis is a newly introduced concept. The answer could be no, because it is already there under OECD model commentary. It is already there under the transfer pricing law in India since 2001, and therefore it would be difficult to say that a FAR analysis is a newly introduced concept. The second principle is that can Rule 10 be applied when the treaty is applicable? Now, the CBDT report says that courts have endorsed the right for the AO to attribute profit under Rule 10 even in the treaties are applicable, which from a statement of fact perspective, the CBDT is right that judiciary has accepted Rule 10. But the question is whether it is right from the treaty perspective under Article 7.2 or a particular definition which is given under Article 7.2 between the two countries, whether a UN model or an OECD model. Is Rule 10 a customary method in India for profit attribution? So compared to Article 7.4 and Article 7.2 and Rule 10, the committee concluded that the attribution of profit by apportionment is well within the mandate under most of the tax treaties, and therefore which method can be customary, whether Rule 10 or the TP provision, is a question to be decided. Rule 10 to be applied only as a last resort or in all the cases. The committee recognized that the Rule 10 is to be applied only when the business profit of a non-resident derived from India cannot be accumulated derived from its accounts of the Indian business. And when you say accounts of an Indian business, again indirectly, you are accepting the distinct and separate entity approach. The larger problem is about attribution of the intra-group transactions for the purpose of calculating the profitability of a permanent establishment. What is the new formula which is proposed by the CBDT? It says the profit attributable to operations in India, in case of a digital business, profit derived from India to be apportioned based on low, medium, and high intensity users, as mentioned in India, and then you have a sales criteria, employees, wages, assets, and the users. I will skip this, but this is what the formula which is given under step 1 and step 2, and then it takes into account the sales of the Indian operation, the sales of the global operations, the number of employees, the wages, the assets. Ultimately, it is taking out the formulative approach, though indirectly it is called fractional apportionment approach. But when you actually go to the formula, it actually apportions the global profitability for the purpose of calculating the profitability of the India operation. And therefore, to my understanding, this needs a reconsideration at the CBDT level. Coincidentally, this has not yet been notified or made effective. And I would believe that post the BEPS action plan, post the G7 decision of the Pillar 1 and Pillar 2, the government would also reconsider as far as profit attribution is concerned. I will skip this slide in the interest of time. What are the computational aspects? The user base. Whether the user base with the revenue, whether you only consider active users or you also consider the passive users. For example, even under SEP, now the 3 lakh users condition is given or threshold is notified, whether you will only take active users or you will also take the passive users. The global profitability, again, I just made a statement about the G7 countries' decision of minimum 15% corporate tax, and what will be the decision of the G7 and G20 countries in the OECD about the apportionment of profit between the Pillar 1 and Pillar 2 formula as far as the global development or a BEPS action plan is concerned. Use of EBITDA. can an industry-specific formula be looked upon? Each industry would have a different threshold for the purpose of EBITDA, and therefore, can you look at industry-specific? And again, it would be very, very difficult to classify a particular industry. For example, a company like ITC. Now, whether ITC is an FMCG company, ITC is a technology company, what is that particular company? And therefore, that will also create an issue. There may be instances where the P owns any assets or deployed borrowed funds for India operation or relies substantially on the fixed asset located in the edge of his jurisdiction. And again, this again takes you to the intercompany dealings or the attribution of the expenses or the income as far as the profit, the dealings between the two head office and the permanent establishment is concerned. The employees and the assets. Will you only take the legal assets or also consider the economic assets? And therefore, the economic value of the use of the assets also should be allocated and attributed to the profit distribution of the India. This is a summary of 7 or 8 judicial developments in India as far as attribution of profits are concerned. The first and foremost is the Morgan Stanley. You are aware that the issue was before the AR, and the Morgan Stanley India was providing a back office operations to the Morgan Stanley USA. And the question was that does it create a service permanent establishment? The Supreme Court said that the activities which are being performed by the Indian entity is a preparatory and auxiliary, it is stewardship activity, and therefore it does not create a service permanent establishment. But when the question calls about attribution of the profits, the Supreme Court categorically stated that no further attribution of arm's length price takes into account all risk-taking functions of the enterprise. Now you should read bullet number 2 and bullet number 4, that additional income attribution is required if the transfer price considers only functions and risk of the Indian affiliates and not of the foreign enterprise. So when you take FAR into consideration, you should take FAR of both the entities into consideration. And if the FAR of the Indian entity has been considered completely, all the risk, and if it is an arm's length principle, in the Supreme Court case, the arm's length was considered to be cost plus 29, approved by a consultant, also accepted by a department as far as the margins were concerned. And therefore, the Supreme Court said that no further attribution is concerned. This is what that single entity approach versus a dual entity approach. Asset satellite, again, the Bombay High Court said that the attribution is based on the FAR analysis, and existence of a dependent permanent establishment is tax neutral, except where the dependent agent is not paid on arm's length basis and upholds a single taxpayer approach. In Galileo and the Rolls-Royce, which I would believe are exceptional cases, where the 15% of the income of the global profits were attributable to the permanent establishment. Since the PE was remunerated at a higher rate, no further attribution was made. Now, this was an ad hoc under Rule 10, which was estimated by the assessing officer and ultimately confirmed by a debit tribunal, and therefore no further attribution was required and was estimated by at 15%. In Rolls-Royce, based on the old judgment of the Supreme Court, 18 ITR, Ahmed Bharti, the Supreme Court in 18 ITR said that normally when you consider a 100 rupee profit, the 50 would come from a manufacturing activity, 15 would come from research activity, and 35% would come from a marketing activities. So based on that, the Delhi tribunal, confirmed by Delhi High Court in Rolls-Royce, accepted those principles that the outside India activities of manufacturing of 50%, R&D activities of 15% is not taxable in India, and only 35% of the marketing activities should be taxable in India for the Rolls-Royce activities which are attributable to India operations. In the Clifford chance, the principle was reaffirmed, which was amended by finance with a retrospective effect, that income in the nature of interest, royalties, and FTS and would not be applicable to the business income. And then the scope of the profits of the indirectly attributable were to be read as if the relevant DTA in determining the extent of profit which would be attributable to the permanent establishment. In Clifford Chance, the special bench did consider about this particular attribution of profitability. In WNS North America, it was mainly considered to be a management and marketing services which were not considered to be fees for technical services. And again, the Bombay Tribunal said that Article 7.1 gives a clear understanding that force of attraction rule is applied only in respect of business carried out by an enterprise by contracting stake in other contracting stake, as well as only when there is an involvement of a PE. So there is a direct judgment as far as the force of attraction principles are concerned. On the Nokia and Motorola by the Delhi Tribunal, it says that again the same principles of the Rolls-Royce, that the manufacturing activity and the R&D activity took outside India, and then the 20% of the profits were held to be attributable to the permanent establishment based on out of the total global net profit, proportionate part attributable to India sales treated as a total Indian net profit, and then 20% of such Indian net profit attributable to the P, 10% for network plant, and other 10% for the negotiation and other sales support and signing the contracts. And then you had a Delhi High Court in the case of Metapath, where the deputed employees were constituted a service P in terms of India-UK double tax agreements, and then the profit attributable to the extent of 8% of the turnover was treated as attributable to India operations. Again, in this case, the rule 10.1 was applied on the percentage of the turnover. In BBC Worldwide, again, it's relied on the satellite and the Morgan Stanley principles, and no further attribution is required if the P is remunerated on an arm's length principles. And the last case is on the Nortel Networks India, which is again a Delhi tribunal, that the employees of the group entity visited India in connection with a contract indicating that the business of the foreign entity was carried out in India to the premises of the Indian entity. Since all activities were carried out by group companies in India on behalf of the foreign entity, the 50% of the global profit should be attributed to the permanent establishment. Now, if you look at this trend of all these judgments, there are three trends based on these principles. Trend one, based on the Supreme Court judgment of Morgan Stanley and said satellite, that once a permanent establishment has been remunerated on arm's length basis, there is no further attribution which is required. Second, unless there is an involvement of a permanent establishment, there is no force of attraction rule, which is typically called a limited force of attraction rule. And third, in majority of the cases, the estimates of profitability based on Rule 10 has been applied even in a case where treaty situation is involved. In other words, though the treaty does follow a distinct and separate entity approach, but broadly speaking, the estimates of profitability based on certain broader principles of manufacturing, R&D, and marketing activities have been identified, and the taxpayers have also accepted this allocation based on certain ad hoc allocation of the profitability. I would not put that it was more on a scientific basis, it was more on the ad hoc basis. And before we open for question answer, let me make last two comments in general. In my practice, when we look at the preparation of or the attribution of profit to a permanent establishment, my personal view is that similar to what you would normally do for a subsidiary company, that what would be the FAR, what would be the actual economic value of the assets which is attributed, the capital funding which is attributable to India operations, and then based on the FAR, based on the arm's length principle, on the methodology provided under section 92C, one should prepare that benchmarking report. And normally, again, my experience is that when you go to department to take certificate under 197, because otherwise it would be taxable at 40%, but the department does accept the FAR and the benchmarking report, which is normally prepared more reasonably on a scientific basis, which you normally prepare for the independent subsidiary company or a group entity. So if you follow broadly those principles, the only additional thing is about the intra-group services or intra-group economic value of assets, where you will need a reasonable documentation to demonstrate that this has been used, along with the underlying documents, which is what we normally call a benefit test under transfer pricing methodology. And if you are able to prove the benefit test for the intra-group dealing, I would believe that that also should be able to attribute to the profitability of a permanent establishment. And then maybe only for the perception factor, if you are able to compare this with a global profitability on a similar footing and a similar foundation, maybe it would be also advisable to demonstrate that the benchmarking exercise which is carried out is also on scientific basis. And the last issue, again on a practical front, that many times the financial statement, the audited financial statements of the foreign entity would include a segment reporting, and that segment reporting will also include the India operations. Now, many times the segment reporting profitability, the segment results of the India operations profitability, and the attribution of profit which you make in India could be substantially different, because accounting attribution of profits or a accounting segment reporting, and for the purpose of distinct and separate entity approach for transfer pricing and income tax purpose could be substantially different. But the only suggestion is that when you prepare this, you should also look at this, and if possible, does a reconciliation between the two, because in my practice I have seen that department does pick up that segment reporting and then say that you are anyway showing 40% profit in the segment reporting. How can you say that you are only taxable at 10% in India? And therefore, whatever information is available in the public domain or whatever information tax department would normally ask from you, you should be ready with that, have reasonable response, have reasonable reconciliation between the two, so that you are able to face the tax department or in the litigation from the judiciary perspective. So thank you very much. And any questions I can learn from all of you, I'll be happy to learn.
There are two questions in chat box, sir. Want me to read?
If possible, yes, sir.
Yeah, is project office of a foreign company qualifies as PE? The company does not have CIN, SIN or any legal entity status.
Yeah, so as I
It's the
said,
project
sir,
office.
as I said, sir, the project office would constitute a permanent establishment, and the permanent, and you will have to prepare a separate profit and loss account. It is also treated as a foreign company under the Companies Act, and therefore you also need to do certain compliances with an ROC, and then you will have to prepare a separate profit and loss account for the project office, including considering the intra-group dealings, which I just gave an example of a France company and the Indian company awarding the project for affordable housing. And yes, you will have to do that compliance as if it is a separate and distinct entity.
Yeah, another question is reimbursement of expenses by project office to its foreign company allowed under income tax for computation of total income.
Sir, if the expenses are in a general nature or an administrative overheads, then there is a limit up to 5% of 44C. But if it is a direct expenditure only for the purpose of earning an income of a permanent establishment, then answer is yes. Then there are no limits.
Yeah, one more question is there. Able to in Q&A, one question is there. I'm not able to take out that.
I am also not able to. I just tried.
Yeah, just having subsidiary in India constitute P. I think that is already answered. This one is in a case where TPO has concluded that the transaction between Indian entity and its AE are at arm's length. Can the assessing officer assessing the AE in India further attributes the profit to India?
So there are three questions involved in this question. The first question is that, as I said, subsidiary company by itself that the shares are held by the foreign company itself does not constitute a permanent establishment. So that's the first answer. The second answer is that if there are transactions between AE and the foreign entity, and if the transactions are on arm's length basis, then you will have to also examine what is the nature of those transactions. Now, the first question is that whether A is a permanent establishment or not. If A is a permanent establishment, and if the profits are attributed on arm's length principle, then nothing further is required to be attributed.
Yeah, I think that's all the questions, sir. We come to
Sure,
an end.
sir.
Yeah.
Yeah.
Thank you very much. We had a fabulous
Thank you,
session.
sir.
So we answered all the queries too. So thank you very much on behalf of Bangalore branch. Divya, can you please propose formal vote of thanks?
Yes, sir. Yes, sir.
Yeah, please.
So, ladies and gentlemen, I take this opportunity on behalf of Bangalore branch to propose formal vote of thanks for today's program. Wholehearted thanks to our speaker, CA Dhinal Shah, sir. Thank you so much, sir, on behalf of our entire managing committee and also on behalf of all the participants. It was really a great session, sir. Thank you so much, sir, once again, sir.
Thank you. Thank you, Mr.
Thank
Shetty.
you
Thank
so
you,
much.
Divya.
Thank you very much.
Thank you, sir.
sir.
Thank
Thank
you
you.
so much, all
Good
the
night.
participants, for your very active participation. Request you to kindly look into Bangalore branch website for further programs. Thank you so much. Thank you, Chairman,
Good
sir.
night. Thank you.
Good
Bye.
night, sir.
Thank you.